Of course, CPI coming out in about 45 minutes' time. The expectation is the economy is stronger than a lot of people have been expecting, and then we get that supply, $39 billion of 10-year notes later at 1 p.m. Eastern. Barclays strategist actually turning short on longer-term treasuries, saying incoming data suggests that the U.S. economy remains resilient with the labor market generating solid real income growth. The rally over the last few weeks seems excessive, and we recommend shorting 10-year U.S. treasuries. Why don't you agree with that, Earl, given the fact that you probably agree with the assessment of the economy, but you are seeing something in the market that just doesn't cohere with that?
Yeah, it's very interesting. You are getting tremors, before you get the earthquake. I'm not saying it's an earthquake, but you're seeing it in the employment number. You're seeing it in some other numbers where, the totality of the number, once you dig inside, is not as strong as the headline. Having said that, we do think we remain resilient for at least the first half of the year. That's why we're not going significantly overweight. But to our point, if we do get a strong CPI number today and we do get a sell-off in bonds, we will be a buyer.
What will you be buying with? Is it going to be moving out the short end into the long end? I mean, this has been something else. What was it, T-bills and chill that we heard yesterday, that some people are saying there's no rush because rates are going to be staying here for quite a while. Do you kind of adhere to that? Or are you saying, actually, this is a good time to lock it in on the long end?
It's a good question. For 2-year bonds, for example, we're not a buyer here. If we get above 475, we're definitely a buyer. So if we get weakness, go towards 475, we'll be a buyer. We still think, the possibility ease is going to be pushed out. It's possibly a Q3, maybe even Q4 story, not a June or July. So that's why we don't like owning 2-year bonds here. 10-year bonds, we don't mind dipping our toes here. As we said, we'll be slightly overweight. If we test the recent highs at 430 to 450 level again, which is a very real possibility, we'll buy some more. And then we'll save our last sort of dry powder for above 450 in case we get there. I'm going to say one thing. Our highest conviction view this year was volatility. That's why at this level, right in between, we don't believe we stay here. And the reason why we expect volatility, there's a lot of credible views out there, us thinking rates go lower, the Barclays and others thinks it goes higher. We will see both sides of that, but we like it from a structural position to be playing this from the long side, given geopolitical risks, given where we are in the business cycle.
If there is more volatility, are some of the riskier credit spots really pricing that in or allowing that to be the case with likelihood of retaining their value?
That's a really, really good question. We actually reduced our credit on Friday, given the new lows we saw in risk assets. We did that through CDX, so we bought protection. And to your point, we still think the economy is going to be resilient and credit will be good, but we want to move up the capital structure to safer credits, and so into IGs. We still have a little bit of high yield, but no triple Cs. We're moving up the capital structure there, just because we think that volatility will impact markets. And, that refinancing walls here, we've had record corporate issuance, but, very good buying to counter that. We have what we call valuation discipline. So we don't like being overweight credit at these levels, although we don't see anything immediate that will sell off credit.
So which one is it? I'm just trying to work it out. There was the price of the story in triple C's just getting too rich.
Exactly. Yeah, you're not getting rewarded enough. I think I said this last time. We're in it for the meat, not for the fat. Where the spreads on triple C's are right now, that's all fat. That's all fat. So we're going to move to areas where there's more meat on the bone and where we have protection, given how mature this business cycle is.
And Lisa mentioned earlier, she asked you, where's the demand coming from? And I would ask a similar question with regards to supply. We've had tons of it, treasury and also in credit as well. Just within credit, where's that demand coming from?
I think it's twofold. I think what you're seeing is some real money players, your pension plans, your insurance, de-risking. So moving from higher risk assets, your high yield or lower rated IGs into higher rated credit or duration. It makes a lot of sense if you're a pension plan, given the risk rally that we've had. You're probably fully funded at these levels. So we believe that's adding to the retail buying and interest in both duration and credit. It's basically immunization strategy.
I have to ask this, Earl. When are we going to start caring about the Treasury auctions more? I mean, I always care about them and their $39 billion of 10-year notes coming later today. They've all been pretty calm. No one cares again. When do we start to care again and talk about the deficit and say, okay, supply is going to matter again for the Treasury market?
Yeah, I think, that's not about, I think people will buy treasuries as long as the economy is resilient. I think inflation comes back on the radar the second half of the year. A lot of things you were talking about prior to my segment, Israel, that's inflationary if that war becomes a hot war or what happens there. Boeing and the salaries of the pilots coming through back in airplane tickets. You spoke about B of A and those wages of executives. So, those are still out there. We're not talking about it now because the market will only focus on one thing at a time, but we definitely think inflation's the second half of this year's story. And when that happens, then you see less people being willing to buy bonds and the supply come back into the picture as well.
Interesting. Oh, great to catch up with you, sir. And I'll do it again, why not? Great start to the year. Earl Davis there at BMO, just nailing that call at the front end of the yield curve. Longer end has been a surprise that yields have come back in the way they have done over the last couple of weeks, but I guess encouraged by the economic data, just not surprising to the upside in quite the same fashion. Lisa mentioned the supply. I've never seen someone hope for a story so much. Hope to make this relevant sometime soon.
100%.
10-year notes, $39 billion worth today, and then I believe tomorrow we get $22 billion of 30-year bonds.
Well, I don't want to make this a story. Let's be honest. I'm not looking to manufacture news. What I'm trying to do here is, no, that's not my business, I guess. But my issue here is that people talk about the deficit. They talk about how supply is increasing, and it hasn't been an issue. And at what point does that become a story unto itself? It's not an issue. Or is this basically just people doing Operation Ostrich on a smaller scale, where basically they're not paying attention until they have to? I don't know the answer to this, which is the reason why I'm asking other people.
Matters. The backdrop matters, and that's the end of the story, basically. And that's what Earl Davis was saying. If you start to see these numbers continue through the year, base case they will, and it's happening as inflation starts to reaccelerate, then supply starts to matter. If it's happened with disinflationary trends that are super durable, then this market can take it.
This is the reason why I'm interested in the tariffs. Because to me, if you start to really get tariff talk at the same time as supply is coming in...
Just say it. You know what you want to say. Liz, Truss.
I'm not going to say it. No, I've moved on. I've moved on. You can get a lettuce and just sit here instead of me.
It's the story that you're not wishing for it, no? Okay.
There's going to be like an AI form of lettuce instead of my head speaking.
CPI up next.
We're operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, the electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit, how can we really tap into new things, continue being disruptive. We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So, I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it?
Peacock, yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
For the Fed here, I do think that they're seeing enough in those inflation readings that will get them to a cut in June.
There's a reasonable risk that they don't cut this year. If you get more of these inflation numbers similar to January, then I think those risks increase.
The start of cuts is not about easing, it's about normalizing, and inflation is what's key.
If you boil things down, the U.S. economy continues to do really well. Inflation is slowing down.
The data needs to confirm we get to 2% or lower before we can cut rates. You need to get ahead of disinflation, leave everything on the table.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Okay, this is it. The third hour of Bloomberg Surveillance begins right now, and the big data point is 30 minutes away. Live from New York City this morning. Good morning, good morning. This is Bloomberg Surveillance. Inflation data just around the corner. Headline, month over month. This is the guess, the median estimate in our survey. Not to offend the economists on Wall Street, I know how much work goes into this. 0.4% is the estimate against a previous number of 0.3. Strip out food and energy, Bramo. We're looking for 0.3%. month over month.
Which is down from 0.4% the prior month. And that really is what everyone's going to be looking at, because there is this gasoline impulse that will prop up some of the all-in CPI. But when you strip it out, that's what the Fed's going to be focused on.
Where does this leave the Federal Reserve, Anne-Marie, a week away tomorrow?
Yep, where it leaves the Federal Reserve, they're going to be focused on this. But Jonathan, as we've been hearing from everyone, this isn't going to be enough. They're going to want another data print. What strikes me is the year-over-year CPI that we're expecting 3.1%. is not too far with the Biden administration's budget put out for their yearly projections. I know I say that this budget is just political.
Sure.
It doesn't matter, but the projections are interesting because what the administration is seeing is 2.9% inflation. That is not going to help them or the Fed when they're talking about a 2% target.
We know what the Fed is looking for. 2024, real GDP, I've got the estimates in front of me, 1.4%. Core PCE, 2.4% this year, 2.2% the year after, 2% is there a few years out.
Yeah, I don't think they're going to change it. They're probably going to keep it there. My thing is that everyone we've talked to today says that the disinflation we've seen so far is kind of going to stop. It's kind of going to stall out. We heard that from Neil Richardson with respect to housing. We heard that with respect to airplane tickets. They're going to go up because of capacity issues, but the demand is still there. You know, these are the things that are going to factor in and that have to be weighing on the Fed, even if you get a bang-in-line print that we get today.
What is in line? Can I just raise that question briefly? Is in line a beat for this market? And by beat, a downside surprise? Is in line sufficient to keep the door open to an equity market rally? Because there is a difference between what the market is looking for and what economists are looking for.
I would argue that yes, in line would be a beat, because right now people are looking for tail risks. They're looking for this idea that maybe they're missing the inflation risk and they've priced it out too significantly. That is the biggest cloud hanging over the market right now, because everybody's priced in and prepared for disinflation, even weakness, but not a reacceleration of inflation.
Inflation data 27 minutes away. The stage is set like this. These are the scores. Equity futures on the S&P 500 positive by 0.2%. Looking across the Treasury curve right now, yields a little bit higher at the front end by a single basis point, 4.55 on a 10-year, down a basis point to about 4.09. That's the story in the bond market. In foreign exchange, the euro just a touch stronger against a weaker dollar, 109.35 on the euro against the dollar. Coming up this hour, fantastic lineup. Citi Stuart Kaiser on why today's CPI report is the biggest risk event this month. Mizuho's Steve Rasciuto weighing in on inflation data. He is not looking for cuts in 2024. And we'll catch up with David Kelly on what he calls the Fed's slow dance downward in rates. We begin with our top story. All eyes on February CPI, just under 30 minutes away. Citi Stuart Kaiser saying this: CPI is now priced as the largest risk event in March. That is a change from the recent pattern, but we agree with it, as the FOMC is at least partially contingent on today's data. A hot report could shift FOMC dots to less than 3 cuts this year, while an easing in month-over-month core inflation would support the seasonality argument surrounding last month's data. Stuart, I'm pleased to say, is with us around the table. Stu, let's get into this. You wrote about this, which is why I've asked the question. The difference between what the market is looking for and what economists are projecting.
Yeah, I mean, I think it's actually similar to what happened on Friday with the labor market report, where I think economists considered that a miss, and from a market's perspective, we're like, hey, this looks like pretty good data. Equity markets are probably going to go higher. So, I do think from an equity perspective, Lisa's completely right. It's a tail risk story. Our view is if you print anything that rounds to 0.3 or below, it's going to be positive for U.S. equity markets on core inflation. I think if it rounds to 0.4, you start to have some issues, and that's going to really put that March FOMC as a key day.
0.3, who does it help? The whole index, part of the index, the big players, the Mag 4, not the Mag 7 anymore. Which part of the equity market is going to do well off the back of that kind of number?
Yeah, I think it helps the market at large, but I think what you'll probably see is things like small cap and some of these things that were traded as rates proxies early in the year kind of start to find their footing again and move higher. It has been a broadening out in the markets for the year in general, though, so I think it's generally a positive print, but it probably helps some of those rate proxies in particular.
I've been citing your research all week because I found it really interesting, and in the sort of guts of it, you were talking about how volatility has been picking up, the same thing that Earl Davis has been talking about just a moment ago. How much does that affect your call for the remainder of the year, whether it's good or bad, in terms of how you price risk at a time where people are expecting more volatility?
Yeah, and thanks, Lisa. We appreciate the support, of course.
Anytime.
You and my mom are O2 readers, so it's very good.
Your mom reads it? Carry on.
Yeah, look, it matters. We've been through a period really over the last 12 to 15 months of an enormous compression in cross-asset volatility on a global basis. So to see it kind of tactically picking up, I think what that tells you is kind of the risk driver of the market has changed a bit, right? As you mentioned earlier in the year, this is all about lower yields, and does that come from a recession or from insurance cuts? The last month, it's been, wait a second, inflation might still be here. And kind of reintroducing that third risk back means people have to readjust portfolios, and you start to see volatility rise a little bit. So I think it is important because it's indicative of sort of a shifting underlying stance among portfolio managers.
How offsides would this market be to that tail risk coming to the fore of a potential reacceleration in inflation?
Quite offsides, I think. I mean, obviously, we've had a month to digest it, which helps. After the average hourly earnings, PPI and CPI last month, I think people started to do a little bit of work there, readjusting how they're thinking about things. But it would be a significant risk. I think the most common, call it market hedges we've seen this year, have really revolved around lower equities and lower yields. What you're describing would be potentially lower equities and higher yields, right? And I don't think a lot of portfolios are set up for that. So I do think it would be a meaningful change. Our view, though, is growth data can get you that big pullback, down 10%. We think if you're going down 10% in U.S. equities, it's probably because you're printing negative payrolls. Inflation, to me, is much more of that 3 to 5% type risk. And the reason for that is you have really strong underlying growth and you have very strong EPS growth. So I think that kind of sets a pretty high floor for equity markets. So I think it would be disruptive, particularly internal to the markets, but the degree of sell-off you can get, I think, is a little bit limited by the really strong growth data.
There's an implication here that's actually pretty deep, and that actually we're hearing earlier as well, which from Mira Pandit, that basically this stock market has shown incredible resilience to any kind of yield move, and that it can handle any kind of yield regime as long as it comes with growth. Are you basically saying that unless it's a really dramatic move, it is immune to potential rate shocks? So you could see a real rate shock in the bond market that doesn't play out when it comes to the stock market?
Immune's a strong word, but I mean, I think this is all, again, it's a discussion about tails. I think the equity market's view on inflation is that deep inflation tail risk has kind of been cut off. And if that's the case, I sort of put that to the side and I start talking about margins and earnings and GDP growth. So if you were to get inflation to a level where we have to kind of respect that tail again, then yeah, that becomes a real risk for the markets. I think we're a little ways away from that. You mentioned Treasury auctions. It was funny, 3 or 4 months ago, that was the big focus. How bad is this? How bad is this Treasury auction going to be? That's also gotten pushed to the background. Today will be interesting, honestly. If you got a high inflation print and then you had to auction 10-year bonds, it would actually be a very interesting sort of combination of data to keep an eye on today. Obviously not the base case, but we'll see how that plays out.
You make it really simple. You keep buying until the labor market breaks. Is it that simple, that straightforward?
I mean, for us it is at this point. I mean, look, it's obviously there's moving parts, and the market's always looking at a distribution of risks and all that, and all those things. But from our perspective, if you keep printing 150 or 200K jobs in the U.S., it's really hard to not like owning equities in that environment, unless you got just a really, really large ramp higher on the inflation side of things.
Is that by the S&P 500 or the equal weight S&P 500? Where's the bias for you now? What's the split?
We still like S&P equal weight. It's made a little bit of a comeback the last couple of weeks. To be fair, it hasn't done great on a year-to-date basis, but you are seeing broadening out, right? That Mag 7 was, call it 2/3 of S&P market cap gains in 2023. That number's below 50% now. So you are seeing broader participation. We haven't seen it get kind of all the way down to that S&P equal weight, and the reason for that is cap weight versus equal weight in the S&P is basically long tech versus industrials, and so we kind of need industrials and healthcare to really kind of move for that to start to work better.
What for you is the labor market breaking? Because we've seen a number of revisions, but the unemployment rate's still under 4%. Where does it need to go?
Yeah, I think if you print sub 100K, the market's going to pay attention. If you print negative payrolls, it's a real issue. We've sort of looked at it as a soft landing would be payrolls between 0 and 100K, unemployment rate stays below 4.5. Hard landing would be you're printing negative payrolls and you get that unemployment rate up above 4.5. But look, if we print 50K, the market is going to really pay attention to it. It's actually unfortunate because last June on a revised basis, we printed 105. It would have been really fascinating if we had printed that live, just to kind of, so we had a better idea of what the reaction function is. I mean, it's easy to say now. Back then, I probably would have cried.
Well, kind of like January.
Yes.
350, not 350.
Exactly, exactly.
So what potentially could shake your view in terms of this idea that the equity market's going to keep on rallying and that it's going to keep on broadening out, even with an economy that is supposed to be decelerating enough to keep inflation under control? Where is the tipping point, the sort of awkward yoga pose that becomes problematic?
It's a great question. I think if you're looking at risks here, labor market's a key risk. Fundamentally speaking, I think margins is what people are really focused on if you're looking 1 or 2 quarters out. And I think the logic there is you had this very high nominal growth the last year and a half, and companies were able to defend margins in there. And I think that might have even surprised some corporates that they were able to push on price the way they were. The question this year is if you're only growing 5% nominal with all the wage inflation in the background, are you able to defend that margin? So if we started to see, that kind of margin turning over, that would kind of be your, let's call that medium-termish, kind of risk. And then obviously you have an, election and stuff on the front burner. But for me, it's payrolls and it's margins would be the two if I just had to summarize it.
We've got to unpack that, how the two are related to each other. When you said defend margins, you talked about pushing on prices, not on reducing labor and cutting costs. Is that the next step? Is that the focus for you?
Yeah, I mean, if you look at the household survey, you've taken out over 1 million, full-time jobs in the last few months. So it is kind of happening in the background. So to your point, these things are all sort of interlinked. It's going to be a question of how do they come together. I think if you're in a strong economy, it becomes less of an issue, right? If the economy really starts to slow, then companies really need to make a very hard decision about margins versus labor versus revenues. And that's why I say that's kind of your, let's call it 1 to 2 quarter out issue that I think the market's going to have to get through.
For now, things are okay, apparently. Stuart Kaiser of Citi is going to be sticking with us. Inflation data is about 18 minutes away. These are the numbers we're looking for in our survey. The median estimate, headline month-over-month, 0.4 versus a previous number of 0.3. Stripping out food and energy, we're looking for 0.3. Previous number in the previous month, 0.4. That data just around the corner, 8:30 Eastern Time. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahara Hackes. Hey, Yahara.
Hi, John. Southwest and Boeing are sliding in pre-market trading. This after Southwest said it will have to cut capacity and adjust schedules due to continued challenges and a drop in deliveries from Boeing. Southwest also sees job cuts by year end, in addition to a hiring freeze for pilots, flight attendants, and other workers. The FDA has approved weight loss drug Wegovy for heart disease patients, a move that could open the door for Medicare coverage. The Centers for Medicare and Medicaid Services confirmed it is reviewing the FDA's action and whether it will cover the treatment. About a third of state Medicaid programs are already covering Wegovy and other GLP-1 drugs for weight loss. Last summer, former President Donald Trump asked billionaire Elon Musk if he would like to buy Truth Social. The Washington Post reporting Musk declined the offer, but it reveals yet another high-profile discussion between the two. Earlier this month, Trump and Musk met in Florida as the former president lines up donors for the general election. Musk took to social media company X to say he is not donating money to either candidate for U.S. president. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on this program, inflation data about 15 minutes away.
You might get a little bit of a stronger than expected inflation number today, but I'm not extrapolating that out to being we're heading back to where we were. This is extremely problematic.
That conversation coming up next, live from New York City this morning. Good morning.
Could face bigger challenges next.
It was going to keep reading World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Pause. There's some things that happen in commercial breaks. Sometimes I try and move on quickly, don't talk about it, just to save Bramo from herself. But on this occasion, you have to repeat what you just said.
Well,
what are you looking forward to?
The Oprah special. It's called Shame, Blame, and the Weight Loss Revolution on March 18th. And the reason why is because he's going to talk about her use of weight loss drugs and give the whole case for them at a time where this is actually one of the revolutions in markets too. So it's a market story, and that's why I'm watching the
sort
Oprah
of get
special.
long GLP-1s the day after the special.
I don't know, maybe get short Weight Watchers, which is I think what a lot of people are doing. But this is really a key question. She's going to host a sit-down, informational, and revealing discussion about shame, blame, and the weight loss revolution.
I thought it was important that we shared that moment. We'll pick up on that story in just a moment. Equity futures right now on the S&P 500, positive by 0.2%. Under surveillance this morning, inflation data just around a corner.
You might get a little bit of a stronger than expected inflation number today, but I'm not extrapolating that out to being we're heading back to where we were. This is extremely problematic. It seems like every cycle we go through, there's another head fake on inflation. Ultimately, the lagged effects of policy tightening start to hit. If you get a couple of unexpectedly strong inflation numbers, well, that'll be a catalyst for some type of pullback.
Here's the latest February CPI, 13 minutes away, with the headline month-over-month figure expected to accelerate. The Bloomberg economics team saying this: ultimately, we don't expect the February CPI report to provide clear enough evidence of disinflation to boost the Fed's confidence to cut rates. Michael McKee, our economics and policy correspondent, with us around a table. Mike McKee, what are you looking for in about 12 minutes' time?
Well, we're looking for some upside surprises. That seems to be the general consensus on Wall Street, that on a year-over-year basis, we see CPI go down because of base effects, but on a month-over-month basis, it might come in hot again. And the real focus for everybody who follows this stuff is housing, because we had a big divergence between owner's equivalent rent, which is what the BLS uses to figure out, we've done this before, of housing prices, and rent. And there was a whole kerfuffle over that. So we'll see what kind of numbers we get in housing, and then what might surprise underneath. Now, Lisa has given me something to work with here, because you remember the refrigerator, when she bought her refrigerator, and that went on for weeks. We checked prices, we checked,
and they were going down.
Prescription drugs are in the CPI, so we're going to check and see.
Are you trying to say that I'm next going on my weight loss revolution?
No, but you brought it up with Oprah, so it gives us something to talk about.
I don't want anything to do with this, Mike McKee. I want to talk about the disinflationary trends. The confidence of this Federal Reserve wasn't derailed by what we heard at the start of the year, even with that blowout payrolls report in January too. Why do you think that was, Mike?
The Fed is looking longer term than the markets. The markets are looking right. Here's what's today, and we try to extrapolate what that's going to mean. The Fed is like, we'll wait until we have to make a decision, and we'll take a look at where we are. Now, there is going to be a question of whether Jay Powell was too optimistic at his Humphrey Hawkins questioning, because he said, we feel like we're getting close here. If CPI comes in hotter than expected, then that's going to not look so good. Now, nobody was expecting them to do anything in March, but we do have a new summary of economic projections, and we have a new dot plot. And so if we get a hot number, it could influence some of the members and change the dot plot a little bit.
That's exactly where I was going to go, because Stuart Kaiser here from Citi has been talking about how this is an incredibly important CPI print, that basically this will be definitive for markets on some level to figure out whether January was just a blip or not. I don't have a sense of how flexible some of the Fed committee members really are at this point to one print, right? Are they kind of going with the assumption that disinflation will continue even if it's bumpy, and that the risk right now is potentially more to the downside for the economy than really to the upside with inflation?
I think they're thinking it's about 50-50 for the economy. What they will do is parse these numbers closely, because there are seasonal effects in here. In January, February, prices tend to go up more because it's the beginning of the year. They have to take those out of the equation and figure out whether what they see is a lasting jump or not. And the dot plot is basically going to be looking at this year. So if you have a hot first quarter, it might push things out farther, and maybe you end up with fewer cuts just because you run out of time. That's kind of where the Fed is going to be looking at this, whereas the markets are going to be looking at this and going, oh, my goodness, we have inflation. Let's push down some bond prices and push up some bond yields and see what we get out of it.
Mike, you framed this perfectly. Stu, going into next week, I think a lot of people on the street, including Andrew Honhorst of Citi, your compatriot over at Citigroup, basically is looking for the SEP to remain unchanged. Is there anything about what happens at 8:30 that could bring that Federal Reserve meeting alive a little bit more?
I mean, I think it'll start the discussion in markets if we round to 0.4 or above. I mean, I think it only takes 2 committee members to raise their dot to go from 3 cuts to 2. So it's a relatively low bar to get there. Again, this is not the base case. Andrew is by far more intelligent on this than we are. But I think from a market's perspective, if you print it hot, the market has to at least adjust what the probability distribution is. It's okay to try to ignore one and call it seasonal. If you get them back to back, I think if you're being intellectually honest about that, you have to respect the fact that those two things happen. I think Mike used the right word, kerfuffle, which is like a fun word for argument, and I think we'll kind of get that kind of situation if we get a strong print.
I'll use another word that Jamie Dimon used, because he likes to do weather reports, but he talked about the potential for stagflation. And at what point do we get inflation that's not accompanied with the strength enough to call it just a hot market anymore?
Yeah, and that's why we're so focused on the jobs market. I mean, I think the equity market is willing to tolerate a lot of stuff as long as that labor market remains strong and GDP growth remains kind of strong. We're talking about stagflation. I think what you're kind of saying is inflation is going to be persistently high. So I think that almost means you're stuck at a level, let's call it between 2.5 and 3.5, that is above what the Fed would otherwise like. And the growth is slowing or is kind of below trend alongside that because of the kind of a give back from maybe all the fiscal spend and stuff we've had. So to me, stagflation that's something that has to play out over a number of quarters or months, as opposed to something you're going to see in like one data print.
I have to go there with the artificial intelligence talk and the weight loss drugs. Is this inflationary or deflationary, sort of in the short and the long terms?
GLP-1 and AI. Look, I think the market is probably thinking of these as more deflationary trends, i.e. AI kind of works against wage growth, and GLP-1 theoretically gets you more labor force participation and reduces spending on healthcare. So if you're being optimistic, that's how you would put it.
Seriously, that people are actually gaming out that it increases labor force participation.
100%, yeah.
Because people lose weight, but they're also healthier and they're able not to miss to go to certain kinds of medical treatments. Is that the idea?
And they're less happy, so they don't mind, just going to work. But Mike can comment on that better.
Well, the weight loss stuff, it's not just weight loss. Scientists see a lot of potential uses for these GLP-1s. So there could be a lot of health problems that would be taken care of that then people could go back to work. The interesting thing about it is you're going to get probably a deflationary impulse from those drugs as they get approved by the FDA for other uses, because then insurance companies will be taking over the payments. It'll show up more in the PCE and the PPI, but it will reduce the price of it on a monthly basis, which would be a short-term win for CPI.
How do you price a story like that? We can all sit here and talk about the revolutionary potential of a drug. How on earth do you come up with a fair PE, a multiple, to put on companies like that?
It's extremely difficult because a lot of companies have this drug, right? There's just a number of them that have caught the bid, so to speak. But I think the issue here is you look at total healthcare spending in the U.S. and you try to model out how much it could kind of erode that, and how many people do you think are not in the workforce because of this? It's a layer of assumptions. So,
what do you think? Can I just ask you this? In the context of a broader portfolio, has healthcare and the position in it as a portfolio manager shifted, just the characteristics of healthcare? Because when people come on the program, they used to talk about healthcare as just a defensive way of maintaining some kind of allocation to equities. Now it feels like pretty constructive, optimistic, super aggressive ways of positioning for a completely different world.
Yeah, I mean, we like healthcare as a trade to the long side from a sector perspective for exactly the reasons you described. It's more defensive. It actually has a positive beta to inflation right now. So if you got that kind of risk-off thing that Lisa's been describing, it should hold in well. It's going to grow EPS about 15% this year, and you've got GLP-1 as a theme. So the view is if the market rallies, it can kind of keep up because it has enough growth to do that. So yeah, we're pretty positive on it. Look, both these themes, AI, GLP-1, have become more than single stock themes. Their earnings, their PE, but they're also GDP growth and inflation. People are talking themselves into these just being like collectively large themes, which is why we have to talk about it.
Mega themes. Stuart, good to see you. Stuart Kaiser, at Citi, alongside Mike McKee. Mike McKee's going to stick with us. He's going to break down the inflation data in just a moment. Reacting to that, fantastic panel for you. Mizuho's Steve Rasciuto on why he thinks we're getting no rate cuts in 2024. We'll get his reaction to the economic data together with JP Morgan's David Kelly. Plenty of price action just around the corner. The biggest data point of the week stateside, maybe even worldwide, is coming up next.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words and then you put a few sentences together, and one day, you might be able to write poetry.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West, only on Bloomberg Television. Context changes everything.
US inflation data just around the corner. The scores going into that information look like this. On the S&P 500, negative, or rather positive, by 0.2%. On the NASDAQ 100, up by 0.5%. In the bond market, 2-year, 10-year, 30-year, shaping up as follows. Yields lower, negative by 2 basis points on a 10-year, 4.08%. On a 2-year, 4.53. With your economic data, CPI in America, Mike McKee has the numbers.
Let's play hot or not, and it does look like we are hot because CPI comes in on a month-over-month basis up 0.4. Core comes in up 0.4. The forecast was for a 0.3 rise, pushes up the year-over-year CPI to 3.2%. Now that is probably energy-related, gasoline price-related, but we will check the numbers as they come in. But the core rises, or actually comes down to 3.8 from 3.9, but that's above the 3.7 consensus. So at this point, it looks like we have a little bit stronger core numbers than anticipated, and we'll just have to look and see where that inflation came from.
Looking for a bigger shift lower in core, did not get it. Equities look like this on the S&P 500, pulling back just a touch. They were positive going into the print by about 0.25%. Now just about unchanged on the S&P 500. We're positive still by about 0.2% on the NASDAQ 100. A clearer move in the bond market. Yields were coming in a couple of basis points on a 10-year, now up a single basis point to 4.1%. These aren't major moves, up about 2 basis points to 4.55, 4.56 on a 2-year. You have to think about where we were 2 Mondays ago, through 4.70 at the front end of the curve. So yields have come down a lot since then, and they're only up by about 3 basis points right now. So yields higher, dollar stronger, the euro dropping back to about 109.20. And looking at this economic data again, we were looking for 0.4 headline month over month. That's what we got. We were looking for 0.3 on core, stripping out food and energy. We didn't get it. We got a hotter Michael McKee, 0.4%. When you look beneath the surface, Mike, what do you see?
Well, the headline number is probably energy driven. We saw gasoline prices for the month up 3.8%. They fell 3.3% in the month of January. So big difference there. Food, everybody keeps an eye on food prices because we all got to pay that. And for the month, we saw food prices flat, which is a bit of a surprise. There was an expectation they might rise some. But I think in the core, the two biggest things that affected the core were used cars. They were up for the month by 0.5%, which is in contrast to the 3.4% they declined in January. So a big change there. And then what we're seeing for owner's equivalent rent is that we have seen that come down a little bit. It's up 0.4 compared to 0.4 for rent. So the divergence that we saw in January has gone away. I'll look for some other big movers, but it looks like used cars played a big role, energy played a big role, and food did not, which is a bit of a surprise.
I'm struck by the market move right now. I'm just watching as people shrug this off, essentially. You're seeing 2-year yields reverse a lot of the earlier move. move. And I'm looking at this and trying to figure out why, Mike, because right now we're seeing the inflation surprise comes from a different place every month. Last month it was OER, it was owner's potential equivalent of rent. Now we're looking at used cars. Why isn't this being viewed, at least by the market? Can you figure out as something that is stickier and multifaceted versus just simply noise on the disinflationary trend downward?
Well, that may be why, because we're seeing a lot of things go up one month, down the next month. And so it's not a consistent pattern of inflation in any particular area. And since you have that, it may be noise. You don't know. Some of these things are pretty volatile. I'm looking for airline fares, which I haven't come across immediately yet because I've got this whole long thing to look for. But that's a good example of things that go up and down on a regular basis. And that's the kind of thing that tells you it's not something that can't be gotten rid of or won't change as we go forward, that sticky would be the word.
Mike McKee, let's go through those numbers again. This is what we got then, 0.4%. The estimate was 0.4%. That's headline, month over month. Core, stripping out food and energy, 0.4% the number. The estimate, 0.3%. So a touch hotter than anticipated. Though as Mike broke this down, what jumped out to me was the shelter index, Mike McKee, just not as bad as it was in the previous month. And I wonder, to some extent, and I hate to mark these comments to market, but we are accelerating again in the equity market, so it's probably worth asking this question, whether we can take comfort from that the shelter pricing story didn't run away this month like it did in the previous one.
Well, I think you can, and I think the Fed will. There was concern because OER went up, and then we had this whole kerfuffle, as we mentioned earlier, about the weighting of single-family houses in the index that the BLS had to explain, and we got half the economists saying it didn't mean anything, and half said it did mean something. But right now, it doesn't matter because they came back down to 0.4. Now, the Fed is hoping they continue to decline, that rent prices and home prices continue to decline, because that's what's supposed to happen. And if that's the case, then we'll see a little bit better numbers going forward, and they can take a little comfort in that.
This stock market has turned around pretty quickly, as Lisa identified. We were lower initially, then just about unchanged. Then a few minutes later, we're positive by 1/3 on the S&P, up by 0.6% on the NASDAQ. The move on yields fading just a touch, still higher by about a basis point across the curve, the 2-year out to the 30-year. In the FX market, the euro just about unchanged against the dollar, 109.26. Fantastic panel for you. Steve Risciuto of Mizuho, David Kelly of JP Morgan Asset Management alongside us. David, first to you, your view on this inflation data of the last 5 minutes or so.
Yeah, I think it's okay. There are some bouncy numbers here. We got a 3.6% increase in airline fares. That contributed to it. We got a 0.6 increase in apparel, which was down 0.7 the prior month. So it's bouncing around. But I think the big picture here is it's kind of like when you take cookies out of the oven. They're cooling, but they seem to be cooling really slowly. And you want that inflation rate to come down faster. And it is coming down. But it's going to take some time, and that's okay. But I don't think there's anything here to alarm the Fed or anybody else. Some of the things that bounce month to month bounced higher in February, and that's why you got this number.
David, just to extend this one step further, is eating the cookie cutting interest rates? Is that what that is?
Yeah, but it's probably, too many cookies are not good for you. So I'm not looking for a very fast reduction in interest rates, and that's okay. I just want to see this expansion stretch out, and if the inflation rate can slowly cool, that's really the best for the economy and for investors.
There's a question, just to continue the analogy, Steve Risciuto. If you leave the pan of cookies on the oven and the oven is still on, do they cool at all? And that is really a key question, essentially, if we're dealing with a lot of these different factors that still are sticky and going and coming, but if you don't have some sort of ongoing tight policy, do they cool at all?
Well, the reality, fundamentally, it all comes down to the labor market at the end of the day. I hate to bring it back to last week's economic statistics, but it really does. The result is that most of the components in inflation that are not going down are components that are service-related, therefore they're income-based, and that's an important driver. And as long as we have an economy that is running with this tight a labor market, and 3.9% up from 3.7%, oh, that sounds like a really big move. It's really not a big move. We're still well below the natural rate of unemployment, which means the frictional level of unemployment in the economy. This is a tight labor market, and it's not generating the easing of the labor market conditions that could say to you, inflation's definitely going to go back to 2%. And I think at the end of the day, the reason why you have a market that's looking through this number that came in hotter than expected is because the Fed's telling you they want to cut rates. So they're not telling you, well, we're looking to see whether we have to raise rates or we have to cut rates. They're telling you, we want to cut rates. The problem is the data is not letting them. And this has been the driving force behind our call all year. And we began it last year in November, that they probably weren't going to be given the opportunity in 2024 because the economy is not going to give them the opportunity. And that continues to be the underlying thought process here. And this data just kind of pans it out.
This is what makes your call really, really compelling. As you say, you are fighting the Federal Reserve.
Well, I'm not. The Federal Reserve is fighting the economy. That's the difference. I'm not fighting the Fed. I'm not fighting the economy. They're fighting the economy. And I hate to tell you, fighting the American consumer is a losing battle. And that's what we're running into. This American consumer, they have a tight labor market, they have income gains, and they're going to spend it. There's liquidity. People are willing to lend the money. They're going to spend money. And that's the Energizer bunny of the U.S. economy, is the U.S. consumer.
David, I heard your voice as you tried to interject, so go for it.
Well, yeah, with all due respect, I do slightly disagree with this whole idea that we're getting inflation coming, or significant inflation coming out of the labor market. It is still a tight labor market, yes. But even in this report today, one of the key variables I look at is food away from home. What are restaurant meals doing? Because that is very sensitive to wages, and they were only up 0.1%. Also, if you look at last Friday, look at labor market data in general, the quits rate is now down to 2019 levels. So people are not quitting in huge numbers. If you look at the National Federation of Independent Business survey of owners, the number of people number of small businesses that say they're going to raise wages is now at its lowest level since March of 2021. So we're not seeing those wage increases. Yes, it's a tight labor market, but we've got a lot of low wage immigrants coming into the labor market, which I think are holding that wage growth down. And I don't see a spread of wages in this report. What I see is auto insurance up 20.6% still. That's pushing up the measured CPI inflation rate. We've got shelter costs up 6% year over year still. That's pushing up the measured CPI inflation rate. But both of those numbers are lacking reality. And so what I think is going to happen over the course of this year is, yes, inflation is going to come down slowly. And I think that's fast. I think that will be fast enough for the Fed to start cutting in June, because we still do have a demonstrably tight monetary policy given the direction of inflation, and we ought to try to move back to neutral.
Steve?
Yeah, well, I think when we go in and start looking at individual components of an index, we're making huge mistakes. This is the point I think Lisa was talking about earlier. This is an index. It has components that are going to move up and components that are going to move down. That's why we use an index. That's why we just don't look at individual components. We look at the broad index. And the broad index is telling you a message. Inflation's sticky. We can argue and say, oh, this month this did this month this did this. But the reality of the situation is the index is not doing what they want it to do. So general price movements aren't doing what they want to do. And they're doing it because of the labor market. And this concept about the quit rates and everything else, we don't have enough historical data of the JOLTS data to make any really valid statistical commentary off the JOLTS data. It doesn't exist far enough back, and we're jumping on these new Vel statistics just like we did during COVID when we were looking at all these things about, how many people were booking restaurants, how many people were going to, taking out a DoorDash and things like that, and they all led us absolutely nowhere. The reality is the index is not going down anymore. It's stalling out. The core numbers seem to be leveling out as well. That's telling us that we still have a tight labor market, and on average, that labor market is generating enough consumer activity to keep this economy going and to keep inflation from coming back to the Fed's target as quickly as they would like it to be, because they're promising to cut rates. And the reality is the economy's not giving them the opportunity. And that's the real driving point.
David Kelly, I'm sure you want to jump back in.
Well, yeah, I do think, even with the JOLTS data, we've got a lot of data. You do have to put together a mosaic of all of these data. I do think it's a mistake to use sort of rules of thumb or how the economy would have operated 20 or 30 or 40 years ago. The truth is, this is not your grandfather's economy. It is not inflation prone. Inflation went up a lot. It's coming down. And even on, looking beneath the surface in the index, I agree if these were small categories. But that auto insurance issue is adding 0.6% to the overall CPI inflation rate, which, we would be at a 2.6 instead of a 3.2 if it wasn't for the auto insurance issue. And again, the shelter issue is also actually more than 50% of the year-over-year inflation rate. So these two things, the way the government is mismeasuring shelter and the way it's mismeasuring auto insurance, if those two things fall out gradually of the CPI numbers over the course of this year, that CPI inflation rate will move down towards 2% unless we have an energy shock. So I think we're still, I still think it's cooling. I think somebody shut the oven off. These cookies are cooling, they're just cooling slowly.
Well, let me just deal with the auto insurance issue, because one of the reasons why auto insurance rates are going up is because when you get a fender bender today, it's awfully expensive to repair the car. Okay, there's a lot more in fenders these days than there used to be in fenders. So the reality is the costs are measuring what's in reality happening. It's not a spurious uptick. That's number one. Number two, when people get into arguing about, oh, the rent-a-shelter doesn't do this or it doesn't do that, the reality is this is the index we have. Let's not talking about, oh, gee, we can get a perfect index. This is the index we have. This is the index we're setting policy on. This is the message that's coming across. The BLS does a very good job at trying to measure these things and measuring them as accurately as possible. And I think all of this second guessing as to what the data is doing undermines the real reality of the situation and keeps people hoping for something that's not happening. This is exactly what the Federal Reserve wants to have happen. They want everybody to keep on hoping that it's going to happen, so it keeps markets in, it keeps the labor market tight, and they hope they get an increase in social welfare. And that's what I think is the driving motivation behind this. And that's the reason why the equity market is up. Let's be honest. You have an economy here where the Federal Reserve is saying, we're not going to upset the apple cart. We're going to keep this economy moving. We're going to keep it going in a forward direction, and that's good for stocks. So it's no surprise to me that the equity market's doing what it's doing. Yep. The corollary is the bond market, on the other hand, is taking the assumption that we're going to get back to 2% inflation. And when people say, oh, this isn't your grandfather's economy or whatever, and we're not getting back to double-digit inflation, the reality is if we're talking a big difference between 2% and 3% inflation, we're talking 100 basis points on the 10-year note. That's huge. And therefore, we can't discount the fact that we're getting stuck around 3, not around 2.
As you speak, equity's doing nicely, up by 0.6% on the S&P. We'll continue this conversation. Steve Rizzuto of Mizuho alongside us, together with David Kelly at JP Morgan Asset Management. Steve basically saying no rate cuts in 2024. David Kelly is basically saying the Federal Reserve should get out of the way. Inflation's coming back down. The conversation continues up next.
Last year was the year of cash. All of a sudden, a lot of these savers who were coming off the sidelines realized I have to do more than have my money sit in a bank account.
The top names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide crate index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you got to be smart about this.
This is Bloomberg.
US inflation numbers out just moments ago. Core inflation topping estimates for a second consecutive month with a very different outcome in this equity market. Equity futures are positive. by 0.6% on the S&P 500. Yields are lower by a single basis point on a 10-year, 4.08%. And the euro is stronger. At least the dollar's weaker. Euro-dollar right now, 109.37.
Which is confounding to me. And it goes to this question, is it the David Kelly version of things, which is essentially that this is just a bumpy road down to 2%? Or is it a Steve Rasciuto form of things where nobody wants to fight the Fed and the Fed wants to cut rates? And frankly, that's what they're going to do. And that's going to support things no matter what. And nothing in these numbers is strong enough to derail that.
David Kelly and Steve Rasciuto with us right now. David Kelly, let's talk about the Federal Reserve. Governor Waller, what's the rush? President Kashkari, why do anything? You've got an answer to that. David, what is the answer?
Well, I think the answer is, to be honest, the Federal Reserve should not be trying to micromanage aggregate demand in the economy. If we've got if we've got a federal funds rate between 5.25% and 5.5%, that is a tight policy. It is designed to slow the economy down. It can cause, it's given us an inverted yield curve. It's causing problems in the pricing of assets and in regional banks. I don't want the Fed to cut aggressively, but I think they should gradually move back to neutral if the inflation rate is heading towards 2%. And so I think they'd be right to start in June, cut again in September, cut again in December, take it easy, but bring rates back down to a neutral level, which I regard as being somewhere in the 3.5% to 4% range for the federal funds rate. But they ought to do that because there's no reason for them to be interfering with the economy, which is actually going in the right direction with inflation, in fact, heading towards where they wanted to go. And on the issue of auto insurance, I realize that auto insurance prices have gone up. I have to pay higher auto insurance too. My real issue is it's up 20.6% year over year now. And whether the government is measuring that wrong or correctly or incorrectly, I'd be willing to put money on the table that won't be up 20.6% a year from now. In fact, I wouldn't think it'd be up as half as much as that. So if it comes down over the course of this year, it's going to pull the CPI inflation rate down. So I do think that inflation is coming down. And if the economy is moving in the right direction, the Federal Reserve shouldn't have its hand on the tiller either way. That's why they should move back to neutral.
Which raises this question, David. Before we go to Steve, I am curious, though, about the oven and the cookies, just because there is the sense that if you have easier financial conditions, as we see today in the market on the heels of a hotter than expected CPI print, that this will actually keep these multifaceted areas, continue to make them hot. Basically, the wall of money isn't going away because real wages are actually increasing. How do you fight against that idea?
Because we've had, for years, we've had an economy which before the pandemic, before we had all this fiscal policy, we had an economy which was quite capable of producing low inflation. Yes, it's a tight labor market, but how many major strikes do we have occurring right now in the United States today? I think the answer is zero. I mean, we're not seeing a very vigorous labor force demanding high wage increases or they'll quit. And so I think you can actually run this economy relatively strong at high levels of capacity without generating higher inflation. And what's wrong with that? So I do think this is not an inflationary economy at its core. We got inflation because of the pandemic, the policy response in Ukraine. That's fading and has really faded. And because of that, I think inflation comes back down to 2% anyway.
This is fascinating, Steve, because ultimately this is one of the big disagreements. Are we entering a new normal, or is this going back to the old? I mean, is that essentially the breach between yourself and David Kelly?
Well, there's this concept that because we were there before COVID, we're going to go back to there. Okay, it's a simple argument. The reality of the situation is the world we had before COVID had two very big differences. One, Larry Summers was talking about secular stagnation, okay, which clearly was not correct. Alan Blanchard, on the other hand, I think was 100% correct, talking about the fact that we had a debt overhang. Well, COVID corrected that debt overhang, okay? The federal government bailed out all the state and local governments. The lower interest rates allowed everybody to refund all or refi all of their mortgages and all their corporate debt at much lower levels of interest rates. Interest expenses are actually no problem for corporate America. That's a big difference there as well. The other fundamental difference that's taking place is before COVID, people were uncertain in their jobs. Okay? There was a high degree of uncertainty in employment. People were always convinced this whole concept of double-digit earnings, corporations making sure they managed towards earnings was going to bring down their employment. They could get fired any moment. Now there's a lot more security in your job. And when there's a lot more security in your job, it doesn't mean we're going to get accelerating inflation. The question is, does inflation come back from 3 to 2? There's a big difference between the two of them. And the big difference is not necessarily an equity consideration, it's a bond market consideration. Because fundamentally, where should the 10-year note be? The 10-year note should take the inflation target, or the long-term outlook for inflation, and add the underlying trend rate of growth to the economy. So if you have 2% inflation, you should have a 10-year trading range of 3 3/4 to 4 1/4. We're basically in the middle of that range right now. If it's 3% inflation, then it's 4 3/4 and 5 1/4. We're nowhere near that range. And this is the fundamental difference. And this is the problem for the Federal Reserve. They have a 2% target. They don't have a 3% target. They have a 2% target. Now, markets right now are allowing them to continue to be patient. At some point, the markets may say, we're not going to allow you to be patient. And that becomes the concern. When the bond market begins to turn around on them and say, you know what, we're not dealing with this, that you're going to get back to 2% inflation. That's the risk if they move. If they move and you wind up seeing the dollar go down dramatically, you could reverse a lot of the goods inflation, disinflation that has been taking place. And if that happens, they then have an inflation problem on their hands. And this is why they have to be patient, and they're probably going to have to be patient throughout the balance of this year. But it's not a negative equity story, because this Fed does not want to set this economy back. It's a positive equity story, and that's what's happening in equities. My consideration is the yield curve could stay inverted a lot longer. And just because the yield curve's inverted doesn't mean it's a problem for the economy, because nobody borrows at the front end of the curve anymore like they used to. And that's a critical differentiation.
You're asking a balance of risk question around the Federal Reserve, and I think it's an important question. David, help us answer it. The biggest risk right now, is it cutting too soon or holding too long? And why do you still believe it's holding too long?
Well, I don't think the biggest risk to the economy is actually the behavior of the Federal Reserve. I think they should, as a matter of long-term strategic policy, move back to a neutral rate, because the economy doesn't need them to be tight at this point. But the bigger risks to the economy are really from outside of the behavior of the Federal Reserve anyway. Geopolitical risks, environmental risks. If something happens to oil, then our entire view of the world sort of changes a bit here. So I think the Fed ought to begin to cut. I think they will begin to cut. But my main point is that as we look at the data month by month, category by category, now we do build up to the pieces of the index because that's how we forecast. We have to look at the individual pieces. And what I see is a global economy which is relatively sluggish. China is sluggish. Europe is sluggish. It's not generating enough demand to push up core goods or even food and energy in any way. So without some supply shock there, the whole goods part of the global economy is not going to give you inflation. I don't see a labor market that is particularly inflationary either, and so that allows you to come down to 2%.
Let's agree on one thing. We do this again next month. David Kelly, Steve Risciuto, to the two of you, thank you. Inflation data just a little bit hotter in the equity market. The green light is still on, apparently, to carry on rallying. The S&P 500 positive, 0.4%. Big day to follow up tomorrow. Looking forward to that coverage from New York City. This was Bloomberg Surveillance.
Welcome back to another BNP Paribas Open update for Bloomberg TV and Radio from Tennis Channel. Coco Gauff got off to a slow start in her third-round matchup with Lucia Bronzetti. The U.S. Open champ saved 9 break points in the opening set before closing it out 6-2. From there, Gauff was pushed all the way by the Italian, eventually closing out the win in the second set breaker. And don't forget, Tennis Channel's live daily coverage from the 5th major hits the air at 1 p.m. Eastern.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
So many people say the only way to really deal with climate change is kind of eliminate oil and gas and then have more clean energy. Is it realistic to eliminate oil and gas in the foreseeable future?
You actually have to at least mitigate it. I think you have to bring a lot of it down and replace a lot of it, but you also have to, you can also have a huge impact by trying to do things like carbon capture and so forth, right, and around it. And it's going to take both approaches. Even today, greater than 80+% of the way the world operates around energy right now is still fossil fuels, you know, when you kind of look at it. And probably what's more striking is the fact that the demand for it is going up every year.
Things like solar or wind, it's nice and environmentally friendly, but really it's not going to be produce enough energy to really replace oil and gas in my lifetime, I assume, right?
Well, not by itself. So let me just say, solar and wind are critical components. You need, this is going to be sort of a collective effort with a lot of different technologies that are each going to come in and take their piece. But we do a breakthrough. We look at technologies that could produce half a gigaton, remove half a gigaton of carbon a year. And the way to think about that number is that we have to remove, say, 100 half a gigatons, you know, a year in terms of what we have to replace.
You formed a partnership with Penny Pritzker at some point to do parking, is that right?
Yeah, so when I was working at JLL, that we went through this real estate recession in the early 90s, and the senior people at the firm said, let's do a retrospective on all these different asset classes to see what happened, how we overpaid, why we ran into so much trouble, what really happened in the marketplace. And when I did that, I recognized, wow, there were a lot of reasons why I liked the parking assets better than I did office and retail and industrial. And so I started really noodling on the differences between those asset classes and came up with a rationale to start a business in the parking space. But I crossed paths with Penny Pritzker, who later became our Secretary of Commerce. And she liked the idea, and she and I went off on this adventure together and built a real estate operating company in the parking space.
From New York City for our viewers worldwide, I'm Danny Berger, in for Jonathan Farrow. It is a Teflon market. Hot-ish CPI readings initially creates losses that quickly reverses into gains for both the bond and stock market. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Coming up, U.S. CPI comes in hotter than expected. That fuels volatility and price action across markets as investors digest the fallout for the Fed. And that's where we begin with the big issue, inflation in America.
The big picture here is it's kind of like when you take cookies out of the oven. They're cooling, but they seem to be cooling really slowly. And you know, you want that inflation rate to come down faster. And it is coming down, but it's going to take some time, and that's okay.
Cookies and all, Bloomberg's Michael McKee joins us now to break down the latest CPI results. So, Mike, a little bit hotter.
I like David's analogy there of the cookies coming out of the oven, because maybe it's warmer inflation than we anticipated. We do see a hotter number come in terms of the month over month for the headline, 0.4%. Changes the year-over-year number to 3.2%, first increase in a little while. CPI core up 0.4 as well, same as last month, but on a base effects measure, the CPI drops by 0.1% during the month. Now, what caused this? It's pretty much kind of what we have been seeing. It's goods prices deflating. It is service prices continuing to increase, and you can see there the blue is goods prices. They're not the problem right now. The Fed has been watching services. At least, as you can see, we did get a smaller rise in services than we anticipated, which is good news. And what did move? Well, car insurance was one of the bigger things that moved, and that's one of the things that has been going up on a regular basis that the Fed doesn't seem to be able to do anything about. Gasoline prices were up 3.8%. Airfares, 2.8% on a year, or 3.6% rather, on a year-over-year basis. basis, they were up 1.4% on a month-over-month, and used cars were up 0.5%. We had not seen that in a while. Used cars had been going down in price. It says airfares, but that's used cars there. Then we look at the owner's equivalent rent and the rent of shelter. This is where the big problem was last month. We saw rent of shelter much lower than owner's equivalent rent. They've kind of come back together now, so less of an issue for the Fed going forward. Where does this all leave the Fed? Well, they've been looking, as you've no doubt heard in many of their speeches, at three different kind of buckets. One is goods prices, and you can see they have deflated. Then we look at services ex housing, which is super core, and it's much more elevated. That's the white line up there, and that did come down last month, but it is still more elevated than services overall. So at this point, it looks like the Fed doesn't have to move anything around for the March meeting, but this doesn't tell us a whole lot about what's going to happen after that.
Mike, definitely the most troubling is girls' apparel going up 6.8% on the month for the biggest increase ever. I think for the parents of daughters out there, the Fed maybe needs to be hiking. I don't know.
They've been shopping at Claire's, I guess. One interesting thing that came up earlier on the show was that GLP-1, you know, everybody's talking about the weight loss drugs, Wegovy, et cetera. Prescription drugs overall fell 0.1%. That would be good news. The bad news is tax preparation up 2.7%. So you'll pay more to file your taxes this year.
Well, it can't all be good, can it? Mike, thank you so much. Bloomberg's Mike McKee. Let's continue the conversation. Joining us now, I'm pleased to say, is Schwab's Kathy Jones and Zach Griffiths of Credit Sites. Kathy, let me kick it off with you. 0.4% instead of 0.3% for the core month over month. Should this and will this shift the tone at next week's FOMC?
No, I don't think it changes anything for the Fed, which was already on hold for the time being until they get more confidence that inflation's coming down. And this is not a number that's going to increase their confidence. I don't think it changes those who believe that second half of the year is the time to start cutting rates. I don't think it's that meaningful, but it doesn't build confidence for the Fed. Even when you break down the component parts and you say, well, it was this, it was that, maybe that's not sustainable over time. I do think the direction of inflation is still down, but it really doesn't give the Fed ammunition or confidence to cut rates at the next meeting.
Zach?
I agree with Kathy. I don't think they're going to cut at the next meeting. And if you were looking for a major downside surprise to bring that on the table, we certainly didn't get it. I think on the core services side, we certainly have some encouraging signs with shelter costs coming down, at least off the peak levels that we saw last month. And I think you're starting to see a trend of a reversal in some of the reacceleration in inflation concerns that we got in data released throughout February. And so if you look at the ISM prices paid component of the services index and the non-farm payrolls, if you take that together with this, I do think things are moving in the right direction in terms of prices, and some of the concerns and more hawkish pricing that we got throughout February is likely to be reduced going forward.
Well, it is very clear that this market has not interpreted in a hawkish manner. Stocks are basically where they were before the inflation print was out, after some movement in between. Bonds at the moment, yields are slightly higher, but after dropping, waffling back and forth, it is maybe a market that is confused and trying to grasp for the narrative. But Kathy, at the end of the day, we have a second consecutive month of 0.4%. To some degree, are you not surprised that that's not causing more of a sell-off at this moment?
I think initially we got a pretty good sell-off because that was a bit of a surprise on the core number. Then you look at the rounding that went into it to push it up there, and it was just a very slight miss. I also think that the market is looking through a lot of the data and saying, okay, does this really change the story on inflation? It may be leveling off in certain areas. Certainly the services side on CPI has been leveling off. It isn't declining the way it was. But we have a lot of other components, as Zach pointed out, that are still coming down. So I'm not too surprised the market's taking it in stride. We also know that the Fed doesn't watch this number as closely as it watches the PCE figures. So this is not probably a game changer for the market. If you thought the Fed was poised to cut, as they've told us sometime in the second half of the year, you probably still think that. We think that. On the other hand, if you believe that inflation is stubborn, but you've got your evidence today. So we've got both sides going, and the market's kind of stuck in between.
Yeah, a classic case of maybe choose your own adventure. Torsten Slok at Apollo has clearly chose his adventure, and that's no cuts so far this year. In reaction to the CPI report, he writes that inflation has started to move sideways and remains well above the Fed's 2% inflation target. This means the Fed will keep rates higher for longer. Zach, that is a little bit of a different view of both yours and Kathy. We're in agreement. The trend is right. So what are folks like Torsten Slok getting wrong when they say the data that's coming in, it is strong and it means no cuts for this year?
Well, I think that he has to have the view that inflation is indeed flatlining from where we are today. And if that's the case, then sure, I think policy needs to remain tighter for longer. But our view is there are still disinflationary impulses in the pipeline, and we think it continues to come down. And so it really comes back to this idea of the Fed's real policy rate, taking the nominal policy rate that we all talk about and reducing it by a measure of inflation. If we use the core PCE deflator, we're at the tightest we've been at any point in the past 6 tightening cycles. And so when we think about recalibrating policy based on the inflation progress we've gotten so far, we think you need to take it down at a measured pace. And so that really all comes down to our inflation call, which we think continues to move lower, and still see plenty of signs in this report that that is a plausible outcome. But if inflation were to remain more sticky, especially in some of these shelter components that make up such a large aspect of the core CPI measure, core PCE measure as well, then perhaps it's more likely that we have higher policy for longer and we get more concern about a potential hard landing driven by that hard policy for longer.
Well, to that point, Zach, Jamie Dimon has been talking that this market is too sanguine on the possibilities for a soft landing. He said the other day that the world is pricing in a soft landing at probably 70 to 80%. I think the chance of a soft landing in the next year or two is half that. The worst case would be stagflation. Zach, you say there's a risk for a hard landing. Are you about where Jamie Dimon is? That's saying maybe around 40% is the only chance we have of a soft landing?
I think it's probably a little bit higher than that. And when we think about the probable outcomes for this year and even into next year, we think stagflation is less of a likely outcome than a hard landing, just because of all the progress that we've gotten on inflation so far. And so I think the Fed has an opportunity to start normalizing the policy rate gradually and perhaps could engineer that soft landing. But if they were to keep policy too high for too long while we still have disinflation coming through in the next several prints, then I think that really increases that hard landing scenario. And so that's kind of how we're probability weighting our outcomes. We still think that the backdrop we have right now is constructive for corporate credit, but we're keeping an eye on what Fed policymakers indicate. So far, I think they want to cut, and we expect to see that in the May or June timeframe.
Kathy, how does your view line up with Mr. Dimon's?
Well, I think he's a little pessimistic about the economy and about the effects of Fed policy. So I wouldn't put a soft landing at 40%. I'd put it above 50%. I mean, when you look around, we still have a good labor market, pulling people in off the sidelines, which means there's enough demand for labor to keep the economy going well. On the other hand, we're not seeing wages push up as rapidly as we did earlier when we had a real shortage of labor. So I think the labor market is normalizing. And normalizing means that, yeah, you have job growth and you have some wage growth, but it's not so hot that it's pushing up the demand side of the economy relative to supply. So I'd be more optimistic than Jamie Dimon and say I think the soft landing scenario is definitely, a plausible outcome here. It's what we're achieving right now. But I would also agree with Zach that they can't keep rates at these levels, real rates at these levels forever, and get a soft landing. At some point, we should see real rates come down.
I will say this market, as it's been digesting through some of the CPI numbers, we do have yields at the highs of the session. 3 basis points is how much we've moved higher. We're at 4.13% on the 10-year yield. Kathy, Zach, you're going to stick with us. Kathy Jones and Zach Griffiths there. But first, let's take a look at some of the stocks that are moving ahead of the opening bell. With that is Abigail Doolittle. Hey, Abby.
Hey, Danny. Well, on that warmer than expected CPI print, we have futures bouncing around a bit, but beneath that surface, Oracle has been steadily higher. In fact, heading towards its best day of 2021 if these gains hold. This, of course, as their cloud revenue growth of 25% is seen as good news. It drove bookings higher, and some analysts are also saying that they like an AI tailwind, too, that they see evidence evidence of that. On Holding, down 14%. Sportswear company, disappointing quarter. Southwest Airlines, look at this, Danny. This is really interesting. Down 8.4%. They are reevaluating their fiscal year guidance on Boeing challenges. Apparently, they won't be able to get as many planes as they had planned. They are cutting the view on how many planes they can get in the air. And when they report their first quarter, that's when they'll actually update numbers too. Investors seem a little bit skittish about that.
Abby, thank you very much. Abigail Doolittle there. Coming up, as people in the U.S. are clamoring for rate cuts, the BOJ is on a different path.
The BOJ can get very important information to decide monetary policy on Friday this week. That was the result of that spring wage round. That could be a catalyst. That could justify that BOJ to move next week.
We preview the week to come for the BOJ next. This is Bloomberg.
Timelessness and sustainability go together, right? You can't expect to be timeless if we're run out of resources. So for me, sustainability is not a side activity. It's not a reaction to external pressure. It's core to who we are, what we stand for. And to a very strong extent, it's about future-proofing our business, right? You need to focus on sustainability to recruit. More and more, that younger consumer we're talking about, they want to work for companies that care about this planet, that do more than just kind of generate revenue and profit. You need sustainability to attract consumers. More and more, including that younger consumer, they care deeply about what are you doing differently? How are you making a difference? Investors, particularly in Europe, more and more place value on what you're doing in sustainability. Many of our partners have expectations on sustainability.
I think that the financial market expect that 50%, but I think that the probability could be higher than the consensus. Because that, as I mentioned, that the BOJ can get very important information to decide monetary policy on Friday this week. That was a result of that spring wage round. That could be a catalyst. That could justify that BOJ to move next week.
Bank of Japan officials are moving closer to raising rates. Bloomberg reporting that a final decision will be made after they see the tally from the spring wage talks that come out on Friday. Joining us now is Bloomberg's Enda Curran. So Enda, where are we at this moment? Does it seem like essentially a coin flip that they normalize policy?
It really does, Danny. It sounds like it's a very close decision. Our colleagues in Tokyo reporting, as you mentioned, is that it sounds like they're 50-50 at best on this. Now, there are a couple of things at play here. First of all, there will be the trade union wage negotiations with those results due on Friday. And by all accounts, it sounds like if that comes in, say, on the higher end of the pay scale, then the BOJ will be green-lighted to move ahead. That seems to be the signaling. And then, of course, the question becomes, what do they do? Do they, pull out of the territory negative rate and bring it back to zero, or do they push it higher? Up to maybe actually increase it up to 0.1, go in kind of a one move and done type scenario. And also, of course, what do they do with yield curve control? So even if we'll say the wage data comes in on Friday, there are question marks over what exactly
policy levers they will pull. And of course, if the wage data doesn't come in on the hot side of things, well, it probably will put the focus back on April, because either way, most analysts watching this story are saying that Japan is edging towards its first interest rate hike since 2007.
Even so, we did hear from Ueda, who said that there's still some weakness in some household spending data. That in itself seemed to weaken the yen this morning. It is weaker by about 0.5% versus the dollar. And I mean, that kind of language, it still seems like a tepid BOJ.
No, absolutely right, Danny. And I think we know with the BOJ, they always want to move somewhat cautiously. They certainly won't want to be seen to create a policy error. Remember, the BOJ in the past has raised rates at times, only, of course, to have to reverse gear on that. On the fiscal side of things in Japan, remember the famous move to increase the sales tax a few years ago that ultimately was blamed for kind of putting a stop in the Abenomics momentum. So the BOJ will be very careful. But nonetheless, though, people watching this story closely have been making the point that the BOJ are keen to at least get out of negative territory, to pull out of it. They're the last major central bank in the world pursuing negative interest rates. That is having a skewed effect on their markets. They are keen to get out of it. They're just looking for an excuse when to do so. And of course, they want to pull off the magic trick, which is, of course, doing that without blowing up the markets and without setting back the economy. That's why it is a pretty tricky task for them. And that's why there's so much focus on the wage data on Friday. If the wages come in hot, then that would give them pretty good cover and a green light to say that they have to pull out of where they are.
I think that's the magic trick every central banker wants to pull off. Fix things, don't blow up the market. Enda, thank you so much. Bloomberg's Enda Curran, Kathy Jones, and Zachary Griffiths are back with us. Zach, does the BOJ need to move now? Is this their window of opportunity before we get Fed cuts, as you and Kathy say, in the second half of this year?
I think it is the BOJ's opportunity. You've had inflation come up quite a bit and had global inflation at really elevated levels over the past couple of years. So we are expecting the BOJ to move this year. And when we think about it from our perspective, it's important from a hedging cost perspective and how attractive U.S. assets become to Japanese investors. But we do think that the time is now for the Bank of Japan.
See, this I find interesting, Kathy, because if the BOJ moves, we're talking about a 10 basis point hike. In terms of yield differentials, it's not that big of a difference. So what impact does signaling have in this case if we are moving towards policy normalization in the BOJ?
Well, the difficulty for the BOJ is if they raise rates by 10 basis points, will the market actually believe they'll raise them by another 10 basis points and another and another and another? Or is this sort of the one-off move that goes so slowly that it doesn't make a huge amount of difference? And I do agree with Zach that they're likely to take this window of opportunity to get out of negative territory. But is it meaningful enough to change the trajectory of the markets globally? And I have my questions about that simply because it is a pretty small incremental move. It will matter to U.S. assets because of the hedging costs, but overall, is the magnitude of the move going to be so big that it changes the global bond structure? I think not.
I got to go back to what U.S. yields are doing right now, because as we've been speaking, we have seen losses start to mount slight, but losses start to mount across the curve. We're higher by about 4 basis points. Zach, when I was saying there's no reaction in markets, you said, yeah, that's about right. Now that we are seeing more selling, is this a dip that you'd want to buy today?
I think that the move that we're seeing now is more commensurate with what we'd expect, even with a modest upside surprise without parsing through all the details. And so I'd be waiting to see what happens with the 10-year auction this afternoon. If you go back to the refunding auctions that we got in February, it looks like end user demand for duration at right around these yield levels is still strong. In terms of buying ahead of that auction, I'd probably be on the waiting side. You have a 30-year auction tomorrow. So in terms of getting a gauge of the demand for duration at these yield levels, especially following at least a slightly hotter than expected CPI print, I might be in wait and see mode for now.
$39 billion of 10-year today, $22 billion of 30-year tomorrow. Kathy, are we back to being worried about bond auctions?
Well, we always have a component of the market that worries about bond auctions, but you know, when I run correlations and I look at the relationship between yield and the size of the auctions and the timing of the auctions, you don't see a huge correlation. So every auction has its story around it. But I think, we could back up a little bit going into this because we got the hot CPI report. But overall, I don't see the market tremendously worried about the auctions or the size of issuance, partly because demand is so strong. We were yield starved for 15 years in this market. And what we find is at 4.5 on the Treasury and certainly 5% in the corporate market, you have tremendous demand coming in to meet that supply. So I guess we can worry about it, but I don't think it's a long-term meaningful problem for this market to absorb the supply.
It's probably better for our health not to be so worried about it, Kathy, so I think that's a healthy attitude. Zach, Kathy has a point. It's not just sovereign bond markets, it's this corporate bond market, a record issuance this year. Demand easily absorbs all of that. Can we continue at that type of pace?
That's a great question, Danny. It seems like demand has almost been insatiable. When we look at some primary market statistics, we have seen some easing, at least in terms of how these deals are getting done on the corporate side. But when we think about where we're heading from here, the conversations that we're having with clients right now are spreads are tight, but yields are still attractive, as Kathy mentioned. And the question we're getting more often than what will make spreads widen is how tight can we go from here? And so we went back and did some work on that. You could see the investment grade market retesting the tights of 86 basis points of a couple of years ago. And the high yield market could even move another 100 basis points tighter to match what we've seen in terms of recent history. That's not our base case, but really that's what investors are focused on as they're more concerned about not or losing the opportunity to snap up yields at these elevated levels versus worrying about spreads widening meaningfully from these levels.
More room to rally. Kathy, Zach, appreciate your time this morning. Schwab's Kathy Jones and Zach Griffiths of Credit Sites. Now, coming up, we're going to get your morning calls, and later we'll be speaking to Luke Kawa of UBS. We'll talk about his outlook for these markets in a post-hot-ish CPI world. That converse still ahead. This is Bloomberg.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it?
Peacock. Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
Nobody brings you top names like Bloomberg.
The expectation that interest rates are going down is creating animal spirits again.
Bloomberg. Context changes everything.
Get your morning calls. First up, Jefferies upgrading Carvana to hold. It points to recent expansion efforts. Next up, JP Morgan upgrades Dollar General to neutral. They expect upside results to send shares higher. Finally, William Blair upgrading Oracle to outperform, seeing robust demand for AI products as shares soar nearly 10.5%. This is Bloomberg.
News and tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure. Don't miss Bloomberg's interview with the...
Your fixed income fix. Watch Bloomberg Real Yield at its new time Friday at 12 p.m. Eastern right here on Bloomberg. Context changes everything.
Just seconds away until this market opens, and it is a market divided on what we think about the CPI report. Headline coming in at 0.3, but core coming in at 0.4, hotter than expected. The expectation being 0.3 month over month. For the equity market, it is still the Teflon market, up 0.5% for the Nasdaq, 0.4 when it comes to S&P. Russell 2000. Maybe this reduces the chance of those 3 cuts this year. So small caps, for their part, disliking that. Now the bond market is a different story. We started out with losses, those flipped to gains, and then losses yet again. Your 10-year yield down, up higher by about 4 basis points. Torsten's Lock says that this reinforces the idea that the Fed cannot cut anytime soon. Dollar stronger, Euro sinks is weaker by about 0.1%, while NYMEX crude at $77.84. Now, one stock to watch at the open, and perhaps the reason that the stock market is still strong this morning is Oracle. They had better than expected results, and that puts the shares on track for the best day of gains in 3 years. Bloomberg's Ed Ludlow joins us now from San Francisco with more. So Ed, here we go. Oracle basically supporting the market today.
Yeah, it's interesting to see that overall top-line growth 7% matched estimates, but the street is going straight to the cloud business where top-line growth was 25%. The split within that's really interesting. Cloud revenue, $5.51 billion. When we talk about cloud revenue in Oracle's case, we are talking about data storage, but also compute power, and the tailwind that they see in that 25% top-line growth is an AI-related story, right? Oracle is trying to work in the domain of other hyperscalers like AWS, Microsoft Azure, and the Google Cloud Platform. The stock now up 10%, and within that split on cloud revenue, $1.8 billion coming from the compute side, $3.3 billion coming from applications. So there is some enthusiasm here. The one number that Oracle talks about is one that in the past we've been skeptical about, which is remaining performance obligation. In other words, that is a measure of the backlog of orders, not yet booked as revenue, but basically deals that are in the pipeline. And what they said is that that figure was $80 billion at the end of the February quarter. The estimate from the street was $59 billion. So we're extrapolating that out and saying, okay, Oracle has its cloud business sorted, its story is AI relevant, and clearly the reaction in the stock market is important. Would note that their software business performed okay, kind of in line with expectations. They have used M&A as a tool to diversify their software offering, but each time they bought a data or software company, they then have to onboard them to Oracle's own cloud, which was a process completed in the quarter just gone. Stock up 9.5%.
Not too shabby. Ed, thank you very much. Bloomberg's Ed Ludlow. All right, let's turn to airlines now. Southwest is planning to reduce its capacity, and part of that, the large part of it, has to do with continuing headwinds from Boeing. Meanwhile, Delta shares, they're also under pressure. They did reaffirm its annual EPS forecast. Bloomberg's Abigail Doolittle joins us now for more. Not such a sunny day for those airlines, Abby.
No, it certainly is not. And for Southwest Airlines, we may be looking at the worst day going back to either March or June of 2020. So investors really not liking this idea that the Boeing mishaps and production issues are hitting Southwest. Now, essentially what they did cut are, they were told that the number of planes that they will receive from Boeing is going to be 46 versus 79 of those 737 MAXs on a year-over-year basis. And as a result, they have cut, as you said, their capacity, the number of planes that they can put up into the air. They are not saying how much this will affect their numbers. They will update the financials on the first quarter, but that's a pretty significant year-over-year change. So some investors, analysts probably flowing that through their models. They're also putting capital spending on hold, and they are not hiring for now. So investors really not liking this. Again, that stock heading to its worst day since 2020. Delta Airlines, on the other hand, is a little bit more hopeful. They're saying corporate travel is returning because something else that Southwest did, one measure of revenue per seat, they cut that guidance as well, talking about the idea that demand is a little bit soft. But Delta's saying that corporate travel is returning and that they've actually had 9 of the top 10 sales days in their history, all within the last 10 weeks. They have, as you mentioned, reaffirmed the guide, but investors not liking it, although maybe there we have a little bit of green for Delta.
There you go, right as we're talking. Abby, thank you so much. Bloomberg's Abigail Doolittle. Okay, another stock we are watching this morning is Archer Daniels Midland. ADM revised 3 years of internal sales after an internal investigation found errors. Joining us with more is Bloomberg's Isabel Lee. Hey, Isabel.
Hey, Danny. So shares are up. Investors are reacting to the company's report that the fourth quarter sales were better than feared. And of course, the revised inter-segment sales for the last 3 years following an internal probe, as you said. So more on this. AMD disclosed $137 million impairment charge related to its animal unit. So operating profits and inter-segment revenues at its nutrition business were adjusted down by tens of millions of dollars in 2021, 2022, and 2023. And ADM has put in place a plan to remediate some of these changes. And the adjustments in charge gives investors really a magnitude of how much this scandal has cost. It wiped out around $7 billion in the stock at the first announcement, and now investors are reacting to positive news on this. So Citi said results were more or less expected. Barclays said that the outlook was achievable, and Vital Knowledge said the news could have been worse. So in January, recall that ADM surprised Wall Street when it replaced its CEO and suspended him following accounting practices. So the SEC was the one who requested for the information, and ADM confirmed in its annual filing that various adjustments didn't really impact earnings at all. And more on the earnings, adjusted EPS fell in the range of $5.25 to $6.25 per share. That's down around 18%, going to the midpoint range. Shares are down around 20% year to date, but today is a good day, up around 5%, Danny.
Isabel, appreciate it. Bloomberg's Isabel Lee there. All right, let's stick with earnings. Kohl's blew EPS estimates out of the water this morning. They had strong sales thanks to Sephora. For more, we're joined by Bloomberg's Katie Greifeld. Katie, this is basically what every retailer wants. They want a Sephora in their portfolio.
Absolutely, especially with Sephora going viral on TikTok. That's another story, though. Let's get into the specifics here, because you're right. We did see some good news on EPS. Specifically, adjusted EPS came in at $1.67 in the fourth quarter. That was versus estimates of $1.29. But it was that miss on same-store sales that's really weighing on the stock this morning. As you can see there, same-store sales in the fourth quarter, they fell by 4.3%. And that is an improvement over the previous quarter's decline of 5.5%, but it does mark an 8th straight quarter of declining comp sales. And this is a particularly painful miss, given that the fourth quarter obviously covers that all-important holiday shopping season. Kohl's also gave what Citi is calling an uninspiring guide on operating margin. Bloomberg Intelligence, though, with a bright spot, noting that a new partnership with Babies R Us and also those double-digit revenue increases at Sephora, they may push Kohl's to actually exceed its annual comp sales guidance. So it's a bit of a mixed bag, Danny, and you can see that in the stock, really wiggling between gains and losses right now.
Katie, thanks so much. Bloomberg's Katie Greifeld. Okay, let's turn back to these markets because we've had that CPI figure out for about an hour now. Luke Kawa of UBS asset management, asset allocation strategist, writing, quote, data so far this year have forced a resetting of expectations in which both the start date for the easing cycle for developed market central banks is being pushed back and its depth reduced. We believe the path of least resistance is for this trend to continue. Joining us now is Luke. So Luke, we have the numbers a little bit hotter when it comes to core. Is this that trend confirmed? We push back the timing and the depth of cuts?
Oh, well, possibly. I do think that that's the bad news part of it. The good news is the reason why. It's not just the stickiness of inflation. If anything, I would say that the more approximate cause for why we've been able to price out so much in terms of interest rate cuts this year has been the strength of growth, the resilience of growth, particularly led by the U.S., but also signs of that broadening out. And what that does mean is that even as we perhaps price out cuts a little more, that's not too disruptive to the equity market. Again, worrying about a world in which we're talking about 2 versus 3 cuts is a lot better than the world when we're thinking about 6 versus 9 cuts because of the possibility that economic activity just decelerates so much.
Yeah, that is a really good way of putting it. Yet we split our hair over 3 versus 2 cuts, Luke. So are we about to live in a world then where growth doesn't necessarily perpetuate inflation? Because if you listen to someone like Jamie Dimon, he says we're underpricing the risk of a stagflation. So can we look through the concern that growth equals sticky inflation?
Well, I would say look at what happened the second half of 2023. You had growth that would be, considered in real terms well above trend, well above normal, and you had this during a period of surprisingly strong disinflation. So that was a time obviously when supply was continuing to catch up with demand, and so you didn't have any kind of constraints on price pressures. Probably that low-hanging fruit is going to be a little bit less hard to come by. So one thing we do think that is going to be in play is that the dark side to this recovery, this nascent recovery we're seeing in global manufacturing, is that the strong support you've gotten from outright deflation in goods just isn't going to help as much in central banks getting aggregate inflation to target. What we've seen year to date in terms of the couple inflation readings we've got is a lot of stickiness in core services. I think that's something that Fed officials have highlighted as something that's concerned them in the past. Powell's talked more recently about how he's more concerned with aggregates again. But again, in our view, you are getting a gentle cooling, a slow slowdown in the U.S. And if you are just looking at the labor market data right now, you would see gentle cooling. You wouldn't see something that gives cause to suggest that core services is really going to accelerate and get out of hand. But it isn't necessarily something that says core services should be at something consistent with a 2% inflation outlook.
Right, and in that sort of global upswing, you also talk about this idea that yes, U.S. exceptionalism, but also look elsewhere. You talk about Japan and Europe. Japanese markets have certainly reflected that. But can you just tell me your bullish case for Europe? Because I think a lot of people have been disappointed about European data over the past many years.
For many years, but also, again, we now have Europe surprising low expectations. When you disappoint for so long, that's the good thing, that eventually it doesn't take much to surprise to the upside. One thing that we've noted is right now, typically, growth revisions are typically very, very highly correlated between regions. Since the middle of 2023, there's only one region that's had growth revised to the upside. It's the U.S. Everything else is completely flat. In our view, that is not something that is consistent with a global manufacturing rebound that we're starting to see. So the chief beneficiary of this, on a relative basis, should be Europe. You should be starting to see those growth revisions between the U.S. and Europe narrow, and with, as you say, the bar so low and people so scarred by perhaps a history of being disappointed in Europe, this is a place where there are cheap markets and the potential for earnings catch-up, and a central bank that I would say certainly isn't going to foist a lot of currency strength that hurts their exporters.
So what would you be buying in Europe? Because at the moment the trade seems, I don't know, Novo Nordisk, maybe some luxury. Are you looking more towards cyclicals then?
So as a general matter, that's kind of our view. We're top down, so not doing anything company specific. And the reason for Europe and the reason for Japan, it's about playing offense over defense here. It's the view that your Europes and your Japans that are more levered to a nominal growth environment that's going to be a lot better than we got last cycle. Those are what works, and what works less in that environment are more defensive markets. Give me Switzerland or the UK on the other side.
All right, Luke, stay with us. Luke Kawa of UBS. Now, coming up on the show, the TikTok bill is picking up speed in Congress.
I just want to see TikTok survive and thrive, but under American protections, in American hands.
We're going to have the latest on that legislation next. This is Bloomberg.
Names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion, and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
Women, on average, have about a 30% lower, I guess, amount of money saved up for retirement compared to men.
Yes.
So what are you doing about that?
Yeah, so we launched a campaign called Retire Inequality. And we do know that women retire with 30% less. Women make 83 cents on the dollar. And so there's a couple of things that we're doing. One, it's having this conversation and making sure that we all are aware that there is a gap. By the way, women live longer than men, so longevity risk is a real factor. Secondly, it's about making sure that we are talking to women about what can you do differently. And so whether that's negotiating pay and what are some tools that are out there, making sure that you take the time to negotiate, because we know women do not negotiate as much as men, which puts you at a disadvantage to start. But then also along the way, making sure that women are securing their own retirement, and that as part of their retirement plan, we're having much more conversation around guaranteed income as well. And so ensuring that we understand what are the nuances for women. If you think about COVID, 2 million women exited the workforce. They did not continue to contribute to their 401k or 403b plan. And so how do we make sure, as a matter of policy, as a matter of engagement, that women can have an opportunity to catch up? That women can understand that if you exited the workforce and now you're back, that's 2 years of compounding that you were not able to take advantage of. And how do we continue to make sure that we're educating them and giving the tools that they need to get back on track?
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg. Context changes everything.
I think that we don't need the Chinese Communist Party telling our kids what to watch online, which is essentially what's going on here. And I just want to see TikTok survive and thrive, but under American protections, in American hands. And everyone, I think, here in America should want that too.
That was Democratic Congressman Seth Moulton of Massachusetts speaking on Bloomberg yesterday. A bipartisan bill that would force TikTok's parent company to sell the platform or face a ban is gaining momentum in Congress. Officials are set to brief House members on the bill today. and then vote tomorrow. Bloomberg's Anne-Marie Hordern and Ed Ludlow join us with the latest. Anne-Marie, we talked about this yesterday, and it does seem like even since then, over the past 24 hours, it's picking up speed.
It absolutely has. We heard from Steve Scalise, the #2 Republican, when asked about, will this have the votes to pass? He said, yes, it will. And remember, he is a Republican. We have to remember, this is very political in one sense, but also then there's the national security concerns that we've heard a lot about overnight. So one to the politics. We saw former President Donald Trump put a little bit of cold water on the banning of it. He talks about that this would make Facebook bigger. And also there's a lot of reporting that he wants the Club for Growth to donate to them. One of those big billionaires is Jeff Yass, who has a more than $30 billion stake in TikTok. Former President Donald Trump recently called him fantastic, looking to potentially shore up some of those campaign donations from some of these individuals. Then, of course, on the Democratic side, you have the Biden administration, with Biden saying he would sign this law if it was to pass through the Senate and the House, yet the campaign is still using TikTok. So a little bit of hypocrisy on both sides. Then there's the national security threats, Danny, and I want to bring you to what we heard from the Office of the National Intelligence yesterday. And they had their annual threat report out, and they mentioned TikTok. They say an accounts run by a PRC propaganda arm reportedly target candidates from both political parties during the U.S. midterm election cycle in 2022. So there's politics that are complicating this, but then when it comes to national security, it's really hard for some of these politicians to not vote yes on this bill.
Well, okay, let's say we get a vote yes on this bill and TikTok needs to be divested. Ed, who would buy it?
Fantastic question. I mean, the answer in the first instance is probably not Oracle. AMH and I were chatting last night, and, you know, TikTok does not come up on Oracle's earnings calls, because even though Oracle is basically housing the data for US users through its data centers and capacity in this country, they made it very clear that back in 2020, they are not going to be talking about that on earnings calls. But I bring it up because Oracle's also incredibly laden with debt, so it seems financially unlikely. There have been reports this week that Bobby Kotick, the former Activision Blizzard CEO, is considering a bid, though the economics of that aren't entirely clear. It's going to be a really interesting week and a really interesting passage of the bill. You know, TikTok spent $10 million almost in lobbying. That doesn't seem to have been that helpful. And then you have everyone weighing in. You know, the Trump argument is that if TikTok is banned in the United States, there are 170 million TikTok users in the US approximately. He sees Mark Zuckerberg and Meta benefiting from that, which he sees as a bad thing. And you will have noticed that Elon Musk, the owner of X, formerly known as Twitter, has taken to that platform in the last 30 minutes to say that this has nothing to do with foreign ownership, because among the issues listed in the bill, foreign ownership is not the sole one. There are many others, and he sees this as a form of government censorship. So it's going to be interesting, but I commend you on raising the question, because for me, that is the question. If the bill passes, who buys it? And I think it's as simple as that.
Yeah, and the direct Trump quote was, young kids on TikTok would go crazy without it. Hard to dispute that that would also be a net outcome. Anne-Marie, Ed, thank you very much for that. All right, let's turn back to broader tech. Luke Kawa of UBS is still with us. Luke, I mean, we can debate until the cows come home about whether tech is in a bubble or not. But Savita Subramanian over at Bank of America, I want to quickly read you what she said about a full bubble for this market. She says that sentiment is neutral. Despite pushback, we hear that sentiment is full bull. Bull markets ends with euphoria, and today's euphoria has been ring-fenced to themes AI, GLP-1, etc. Would you agree with that, that we're not full bull, it's really just these very specific segments of the market?
I mean, I think that's very fair to say, and I think I've been pointed out ad nauseum, but a big difference between now and the mid-90s is the fact that, hey, what's happened to certain companies' PEs as they've boomed? They've gone down. It's been a story of fulfilling the earnings growth that's been priced in, and you know, as investors, you know, the half of the game is you go where the earnings growth is, expecting it to continue, or you go where you expect the earnings growth to be improving. You know, that would be, the improving side would be your kind of your Europe, but go where the earnings growth have been. That's, you know, that's Japan, especially the, you know, the story of share shrinkage there, and that is also still U.S. tech in spades.
I have to say, it is really interesting that tech stocks in the wider market have been somewhat immune to higher rates. Today, rates are moving higher. This bond market's up by about 4 basis points, and gains that we saw in the stock market this morning are starting to peter out. You can see it on the screen. They're a little changed lower for the Russell 2000. Does that immunity to yields moving higher, Luke, does that change as we continue to push out the rate cut narrative?
Oh, I think that's certainly a possibility. However, you have to kind of go, what's the causation here? And why would we expect a certain segment to be underperforming as yields go up? For instance, if you think yields going up on a lot of strong growth, cyclicals are going to capture more of that growth and they're going to have better earnings than the rest of the market, well, that's a reason for tech to be underperforming on rates up. If we have what we have now, which is still seems to be a full boom in at least tech CapEx spending, rate story right now.
Yeah, and just the fortress balance sheets of them, the huge piles of cash they have protecting them and working for them when rates are higher. But Luke, when you look at what's hedged in this market, it is upside hedges. That seems to be what's in vogue at the moment. Is there some degree which maybe this is an overly complacent market?
I mean, on the one hand, there's upside hedges. On the other, Bloomberg's published, I think, some great stories on still a lot of new, effectively short vol ETFs that do effectively collect a lot of assets along the way. Is the market overly complacent? I would say, not necessarily. The market is well pricing the increased likelihood, as it has over the past year plus, that recession is just getting less and less likely, even despite all the monetary tightening that had been brought to bear.
We're out of time, and I couldn't even ask you about Volmageddon and those short ETF, those short vol ETFs. Luke, thanks so much for joining. Really great to see you, Luke Kawa of UBS. This is Bloomberg.
How are you feeling right now about the state of the industry and what it's going to look like in the next couple of years?
The big picture is it has never been more, I would say, volatile. I mean, it has, but it continues to be volatile. But like you said, we did see real signs of life this summer. So generally speaking, box office is down globally around 20% to 2019, so pre-pandemic levels. But this summer, it was 5% down. Right, so it would suggest that even though there were winners and losers of this summer, and obviously we had the two big juggernauts with Barbie and Oppenheimer, movie-going begets movie-going, right? So when there's a season filled with, good movies that people want to see, I was made to feel pretty optimistic about what we saw in the summer.
Hotter CPI report, 0.3% for core, 0.4%, 0.3% was what's expected. So here's what's up next. Today, presidential primaries take place in Mississippi, Georgia, and Washington. Then VW and Adidas report earnings on Wednesday. Then we get more data, U.S. PPI, retail sales, and another round of jobless claims come out on Thursday. And then we round out the week with you, Mitch. For now, it's yields higher by about 5 basis points after that hotter CPI. This is Bloomberg.
timelessness and sustainability go together, right? You can't expect to be timeless if we're run out of resources. So for me, sustainability is not a side activity. It's not a reaction to external pressure. It's core to who we are, what we stand for. And to a very strong extent, it's about future-proofing our business, right? You need to focus on sustainability to recruit. More and more, that younger consumer we're talking about, they want to work for companies that care about this planet, that do more than just kind of generate revenue and profit. You need sustainability to attract consumers. More and more, including that younger consumer, they care deeply about what are you doing differently? How are you making a difference? Investors, particularly in Europe, more and more place value on what you're doing in sustainability. Many of our partners have expectations on sustainability.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Tuesday, everybody. You made it to the second day of the week. I'm Alex Steele here with Paul Sweeney is on vacation. Jen Ryan is here with me for the next 2 hours. Markets take that warmish CPI in stride. That's my takeaway, but probably your air first from Southwest are going to last longer. And John Tucker, the most important notice came from you today. Over 19 million people did watch the Oscars with me. It just wasn't you, and now I know.
19 million people I'll never meet.
But you met me.
Oh, well, I have you. That's
that
true.
happened.
You're
All right,
the
why don't you
outlier.
Uh,
give us a biz flash here, John Tucker?
Stocks higher, yields are higher after today's hotter than expected inflation report with the CPI this morning. 6 of the 11 major industry groups in the S&P 500 higher right now, being led by technology shares, communication services, and information technology. Now to the CPI, the so-called super core measure. I'll focus on that. Core services prices, excluding shelter, that rose about 0.47% on the month. So that's down from the 0.85% in January. David Kelly at JP Morgan Asset Management reacted to the hotter than expected inflation report.
But I think the big picture here is it's kind of like when you take cookies out of the oven. They're cooling, but they seem to be cooling really slowly. And you want that inflation rate to come down faster. And it is coming down, but it's going to take some time, and that's okay.
Well, right now the S&P 500 up 22 points. That's a rise of 0.5% at 5140 on the index. The Dow Jones Industrial Average up 105 points. The Nasdaq 100 83 points higher. That's up right now 0.5%. Now the 2-year yield, which I say is more policy reactive, 4 basis points higher. That's at 457 right now. 458 we'll call it. The benchmark, the 10-year, 4 basis points higher. That is at 415. And this markets report being brought to you by IBKR. Investment advisors switch to Interactive Brokers for lowest cost global trading and turnkey custody solutions. No ticket charges, no conflicts of your interests at ibkr.com/RIA. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash.
All right,
Jen
John
and
Tucker.
Alex.
Thank you so much, John Tucker. I'll try not to call you Paul today, but I'm not making any promises.
That's all right.
Maybe Jen.
I've
you'll
been
call him
called a
Paul.
lot worse.
Or you could call me Paul.
Okay, we'll just go with that. I mean, either one. Jen, what's interesting is just how much equities are actually holding in, and I wonder if it was a sort of sell the rumor, buy the news. Like, are we in that environment with the CPI?
Yeah, which is all turned around. But I think people were so braced for some kind of a nasty surprise, like we get in January, like we've had in months past. And so the fact that it kind of came in as expected, people didn't quite know perhaps how to take it.
Yeah, exactly. So good thing Abigail's here. Abigail Doolittle, Bloomberg News markets reporter, joins us. What did you make of the market reaction?
I would agree with both of what you are both saying. Maybe a little bit of sell the news, then buy or sell the rumor, buy the news, and not as bad as feared. It was, it's hard to call it hot. I couldn't hear David Kelly, but I heard him earlier, and if the soundbite was used where I was talking about it, inflation being like a warm cookie coming out of the oven, and that it could take a little bit longer to cool than you like. It's appropriate, and that was what happened in the 70s, and that's also why I think the Fed hasn't been rushing to cut all that quickly, because they want to make sure that inflation does go away. I think that just the fact that it wasn't, too much worse than feared. We have the S&P 500 right now up 0.4%, the Nasdaq up 0.4%. What is interesting, the Russell 2000, the futures had been higher earlier. Now the actual index down ever so slightly. Some of the Goldman Sachs most unprofitable tech companies, that index is down 0.9%. So some animal spirits cooling there. Bitcoin, on the other hand, up still, not a huge gain, but up 0.5%. The VIX in, so net, investors are saying, this was, sort of basically next. What's next? Which is the Fed next week.
Yeah, indeed. We don't have a lot of other data between now and then.
We don't.
We have producer prices, we have retail sales, and then the speakers are in a blackout period. So there's not a lot for the market to hang on to. And because there's not a lot for them to hang on to, and this is at most an ish sort of CPI release, it's hard for anyone to get a clear direction.
Yeah, I don't disagree with you. And in fact, if I take a look at the S&P 500 chart, the chart's kind of just meh along. It's stuck in this little near-term range. But that is a part of a beautiful uptrend. At some point, that uptrend is likely to either consolidate in a serious way, so there can be the next big leg, or actually just even crack to the downside, something that we've been talking about for weeks now. And yesterday, in putting together some charts, I noticed yet another bearish divergence. The all-time highs that we've had this year have been made on less bullish momentum than the all-time highs made last year. So that tells you that weaker hands are buying. In addition, last year when we had record highs on two different occasions, we were looking at 90% of the members above their 50-day moving average. Right now, it's closer to 77%. It's on the upturn, but it's still below. So another bearish divergence, just less people enthusiastic.
What's interesting is I want to get to the Bank of America call that came out today. We know that they upgraded their forecast last week. This was upgrading their earnings forecast. But I found the why behind it really interesting, that they're looking at the hyperscalers. So Microsoft, Amazon, Google, Meta are set to spend $180 billion in CapEx this year. And basically, they're entering a reinvestment cycle. That's their thesis. And that's going to be the virtuous circle that's going to drive earnings higher. I found that to be interesting and separate from, say, CPI.
Yeah, that is interesting. I have not read that report, but in theory, that is what should happen if that kind of money is going to be going out into not into the economy, but to all of those various supply chains. Could something derail it? It would have to be from a real macro standpoint. It's interesting because at this point, we, for the most part, the idea of some sort of a hard landing or non-soft landing has been dismissed, and yet Jamie Dimon, who last year was calling for 7% Fed funds rate, he just recently said, don't count it out. We could still see some sort of recession. And something I'll bring up, Alex, is your wheelhouse, commodities. Commodities last year down, I think, 12 or 13%. This year down. Mike McGlone and Vincent Piazza, some of our commodity specialists, both saying that decline is demand-driven and that they see that as some sign that there could be economic weakness ahead. So, there's still some uncertainty, but net things feel and look pretty good. That said, the technicals are pretty stretched. Some sort of pullback would be healthy.
I wonder now, if if you've got any read across from what stocks are doing, what bonds are doing, to what expectations are for the Fed at this point, because it's kind of a bit hard to parse what this reading means in terms of what the next move is going to be.
Well, based on the move after Fed Chair Jay Powell spoke to the banking committee, Senate Banking Committee last week, I think that's who he spoke to. He was in Capitol Hill, Congress, 2 days. And the relief that we saw from markets, I think the main thing that investors were happy about is that he is still in the cutting camp, because we've had some notable market folks saying that we may not be cutting this year. And frankly, if I were to take a view, I think that there could be some reason to believe that, just because of commercial real estate, the housing market, and some other, and if we were to see any soft patches for the economy. So there's some folks out there saying that, but Powell didn't indicate that in any way. So I think so long as there's cuts this year, and I think right now we're pricing in 3 to 4, depending on where the investors are with the data du jour, I think that that's the main message that they're expecting him to hold the line. I think that the expectation is no cuts next week, but for him to hold that line that yes, we will be cutting this year.
All right, Abigail, thanks a lot. Really appreciate it. Abigail Doolittle joining us on All Things Market. So the markets now to the data. Let's get more with Ira Jersey. He's Bloomberg Intelligence Chief U.S. Interest Rate Strategist. And kudos to Ira. He's been saying before it was long popular that the Fed was going to actually cut a lot later than the market was expecting. Once they start, they might go for a bit longer, but they're going to push it out. And it looks like that view is now really the prevailing wisdom. So, Ira, thanks for joining. Your take on CPI.
Yeah, so CPI obviously a little tiny bit better than expected. Some of the data was weaker, some of it was a little bit better. But I think the preponderance of the data just suggests what we've been pointing to all along, and that's that a lot of the stickier sectors within inflation are going to continue to prop up inflation, and it's going to be very slow for inflation to come down more meaningfully than it already has. So I think at this point, just going back to your discussion about the Fed, I think this does mean that even if the Fed does cut this year, which I think ultimately it will, it's a matter of when does it start, and that's not the important question to be asking. I think at this point, it doesn't really matter when it starts. In my view, it's how far will they be able to go, and then ultimately what's the terminal floor that we get to sometime in 2025 maybe, or even early 2026. So will they cut in May or June? That's less important, I think, than, hey, are they going to cut 200 basis points or 300 basis points, right? That's, I think, the more relevant question, certainly for the rate market at this point.
Can you dig in a little bit to today's release? I mean, we saw there's some changing around in different categories, and there's a worry about how consumers are going to take it, because some stuff that they feel directly in their pocket, like non-prescription drug prices, for example, some clothing prices are up. So what's the big takeaway here in terms of the categories?
Well, there's always disconnects, and certainly some prices are going up and some prices are going down, and in part it really depends on the basket and what the weights of those are as to what the headline number comes out to be. But how we break down CPIs, we look at the core CPI sectors and break down into high volatility, low volatility, and medium volatility sectors. And what tends to happen is the lower volatility sectors, so that's the housing and some of the other consumer services sectors, those tend to move and trend very slowly and tend to be stickier, both going up and coming down. And those actually rolled over just a little tiny bit today compared to the last couple of months. So I think that that's a positive sign, but they're still not coming down quickly. Meanwhile, goods prices for the first time in a while have started to show a little bit of signs of life, and those tend to be higher volatility sectors where prices go up and down based on demand, based on supply chains and things like that. And the fact that those have been actually a drag on CPI. Those aren't as much of a drag on CPI as they've been over the last 6 months. So because of that, if those continue to climb, you could actually get even stickier inflation prints, like continued 0.4 prints, which would not be good for the Fed and what they want to do in terms of their potential interest rate cuts later this year.
Yeah, Ro-Ro. Is that you think it's a supply chain issue or a demand thing?
Well, I think it's mostly a demand thing. So the other piece of information that I have been looking at closely is things like real wages. And when you look at real weekly wages, they continue to be positive. So basically the wages that in aggregate, I'm not saying that it's every sector or every person, obviously, but in aggregate, wages are going higher and faster than inflation is rising. And because of that, that just suggests that the consumer is actually in pretty decent shape and going to be able to continue to spend spend what they're making by continuing to have decent wage increases, and that ultimately is feeding into things like the services sector, because services, a large part of the cost of doing services is our wages, and if wages continue to rise in those sectors, you'd expect businesses, service businesses, to continue to raise their prices at least a little bit to keep up with the amount of extra wages that they're currently paying.
I mean, I guess if you put together rising wages, a strong labor market, and then on top of that, you've got an incredibly healthy, to put it mildly, equity market, a big run-up in prices, that's not the kind of environment where one cuts rates. And it's certainly, you don't want to start signaling to people that what we need now are easier conditions. And so do you have any thoughts creeping in that maybe the signaling from Powell and from some of the more dovish members of the committee has been a little bit premature?
Well, yeah, we thought that late last year as well, because what happens is what happens is when you're signaling that you're going to be cutting interest rates at some point, the market will price for that, and that's exactly why you've seen the yield curve continue to be inverted. That's why you've seen the market pricing for cuts through the end of 2025, and all of those things ease financial conditions because most people don't have short-term debt anymore. You can talk about credit cards, but I'm not sure the difference between paying 23% and 25% in credit cards on credit card interest is really going to make that much of a difference in the big picture. But for when you think about financial conditions for the corporate sector, when you think about it for people buying cars with 5-year or 6-year or 7-year auto loans, when you think about households in terms of mortgage rates, even though they're higher than they were the last decade, they're still much lower than they were a couple of months ago. All of those things ease financial conditions and can maintain the economy for a bit longer. So just the fact that they're talking about wanting to cut interest rates has eased financial conditions quite substantially, and I think that that's not helped them in their race for getting inflation lower.
Yeah, it's like that virtuous circle. You just keep on sort of your hamster, and it just keeps repeating and repeating. I'm looking at the curve. We are looking at selling pretty much broad-based. The 3-year yesterday, the takedown was okay, and indirect bidders came in nicely for that. We have a 10-year today. Since Paul's not here, we can talk about steepeners. What are you expecting for today?
Yeah, so it's possible that we see some yield curve steepening, but I'm not sure. But it's likely to be bear steepening. So what I mean by that is that long-term yields go up faster than short-term yields. And one of the reasons for that is what you've just been talking about, Alex. It's the idea that maybe inflation's not going to come down as quickly, so the Fed won't be as aggressive in their interest rate cuts on a forward basis. And because of that, the 5-year, the 10-year yield might have to go up a little bit faster than, say, 2-year yields. I think that that's completely reasonable in the short term. Longer term, that's probably not the case. More likely, short-term interest rates will go down. But the tactical dynamics of what's going on in the markets, what's going on with Fed expectations, I think is really going to be driving the curve trade right now. I don't see any reason that the curve is going to uninvert this year because, more than likely the next Fed move is going to be for lower rates and to lower rates. So therefore, it's going to be hard for 10-year yields to get up to the same level as 2-year yields. It's more likely they all move up and down together than it is for a trend of 10-year yields underperforming 2-year yields, for example.
I wondered if I could ask you quickly to shift gears a little bit and think about what the next BOJ meeting could mean for the U.S. economy and for U.S. rates. Because if we see the BOJ finally escape negative interest rates, is there an expectation that there could be some selling there of U.S. assets that as people repatriate money back to Japan?
Yeah, maybe a little. Certainly on the day, you get a lot of volatility in the markets where if 10-year JGBs sell off 20 basis points, the U.S. market and the European government bond markets will sell off 5 or 10 basis points, right? That's more than likely the relationship between the two. Will it be that systemic? There's a lot of people saying that there'll be some kind of reverse carry trade where people will repatriate money to Japan because there's positive yields. I think it's more likely that there'll be less of the carry trade as opposed to actual money going back the other direction. Because even at 10 basis points, short-term Japanese rates are still significantly below that of the U.S. Right? And at the end of the day, positive yields are going to be something new, but it's still the relative the interest rate differential that's going to matter much more than the absolute level of their
Totally.
rates.
And even if you get like 300 basis points of cuts, like that yield differential is still pretty wide. Ira, good stuff. Thanks so much. Pretend I asked a sports question that was funny. Ira Jersey, Bloomberg Intelligence Chief U.S. Interest Rate Strategist. Do you have a sports thing, Tucker?
No, absolutely. I need to do a correction. If you were in that interview quoting Astro, it's Rutrow. Rutrow.
Excellent. Thank you. I appreciate that.
Astro Jetson. You remember that?
Rutrow.
There you go.
I noticed that wasn't deeper. Rutrow.
No, you didn't. I don't know what you said. What was it? It wasn't Rutrow.
This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom. This is Bloomberg Business Flash. Well, stock investors right now seem to be shrugging off that hotter than expected inflation print that we got this morning. And in the Treasury market, only a slight pairing of expectations for a Fed interest rate cut beginning in June. In the S&P 500, you had 6 of the 11 major industry groups higher. Information technology and communication services leading the way. That's where you can find shares of Oracle. They're posting their biggest intraday gain in almost 2 years. They reported after the close yesterday a spike in bookings in their cloud computing business, and shares of Oracle right now up close to 11%. And then you have the retailer Kohl's reporting same-store sales in the fourth quarter that missed the average analyst estimate. Kohl's share, the ticker symbol KSS, they're down right now 0.3%. And then a quick look at 3M shares. They're getting a lift after the company named a new chief executive officer. And right now, the Dow Jones Industrial Average 121 points higher. That's up 0.3%. S&P 500 30 points higher. That's up 0.6%. 51.47 on the index, and the Nasdaq 100 115 points higher. That's up 0.7%. The 2-year yield 4 basis points higher at 4.57. We'll call it 4.58. The 10-year up 4 basis points. That is at 4.13. Now we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Alex.
Yes. Hello.
Back to you.
Thank you.
Hello, Alex.
John Tucker. All right, so let's take another look from an investor perspective on what do you do now? Like, we got through CPI. It was a little bit of a sell into the news and then buy the news kind of situation. We're still going to grind higher here. So it seems Bank of America now upgrading their earnings forecast, really looking at a hyper investment cycle when it comes to the big tech guys. So what do you do? Margie Patel is Senior Portfolio Manager at Allspring Global Investments, and she joins us now. Margie, do you buy into this now? Like, is there, again, it feels like we just can't sell. So you have to throw in the towel here and buy no matter what and hold on?
Well, yes, because fundamentally the economy looks in good shape. It looks as if we're growing, say, between 2 and 3%, which is good enough to have earnings up, say, 10 or 12% for the year. So that's really pretty attractive for equity investors. And you can see the Fed is really betwixt and between. They'd like to cut rates, but they really can't when inflation is so stubbornly a little bit above their target. So that's why you're seeing mixed signals. Bond markets are down a little bit in price, but equities up a little bit in price.
Can you talk to me a little bit about your take on the equity market? Where do you see investors should be concentrating, and where do you see that they should be staying away a little bit?
Well, I think it's still the same themes that we had last year. Although the market might be broadening out a little bit, it's still sticking with companies that fundamentally look like they have above average long-term secular growth. So that says to me the tech sector is still going to be one of the strongest. It's certainly volatile as short-term traders change their sentiments here and there. Basically, I think the trend is still your friend in technology. And I think in industrials, particularly those companies that are going to benefit from reshoring, from higher capital investment in certain areas, I think those companies are going to do well. They're priced reasonably, and they should have growth that's actually pretty competitive, even with some of the tech sectors. And we've had a little bit of a turnaround in healthcare. People really trashed the sector because of down earnings from COVID. Mm-hmm. So I think we're seeing more money attracted to the healthcare sector.
What about industrials? We just heard Tucker talk about 3M changing CEOs. That has been a really rough ride for 3M. They pretty much like make everything, and they have so many parts of their business that sometimes that winds up hurting them. Where in the industrial space might you be looking?
Well, I think 3M is really a special case. You have to look at the company, the fundamentals. They just have a new CEO and look at it afresh. But as far as the rest of the industrials, I think that they should, on balance, look pretty attractive because a lot of them will benefit from higher capital expenditures. They'll benefit, I think, from the reshoring, less competition from, say, China, for example. And also, I think that as far as what we're seeing as far as the government with their encouraging more investment in semiconductors with needing to upgrade the electrical grid, I think those companies are going to do surprisingly well. They're priced reasonably, so I think they can easily be one of the more competitive sectors this year.
What's your view on more consumer-facing companies? You know, we're still seeing inflation quite powerful, and consumers still feeling squeezed, but at the same time, it's a hot job market, hot salaries.
Well, I think the in the consumer sector, I think that the discretionary sector is likely to do a bit better than the staples sector, simply because people do have more people have jobs. We have salaries going up small enough, maybe not enough to totally compensate for inflation. And the staples, I think, is a sector that I'm sort of lukewarm on. I think it's going to be hard to grow. There's excess capacity. They don't have pricing power. And fundamentally, those markets are rather slow growth. So unless a company can reinvest itself in the staple side, we think the discretionary is a better place to be for consumers.
Hey, Margie, do my homework for me. I try and come up with a couple themes every day. Like, these are the main questions that we're all thinking about. These are the main themes. I gotta tell you, I don't have one today. It might be me. I mean, I'll put it out there. It could very well be me. But what's my question today? What are the main questions we have now?
Well, I think it's just more the same and really do nothing because there's really not a lot of productive things to do here.
Okay, so it's not my fault. My takeaway is that that's not my fault.
No, and position because they would love to cut rates, but they really can't when inflation is stubbornly high. Trends coming down, but not enough to justify cutting rates, and they're well aware of the interest rate burden with the huge deficit. So they're really betwixt and between, and so they really can't do much except maybe talk every now and then. And the companies are just motoring right along. Earnings are once again surprisingly good in the last quarter. I think they'll continue to be surprisingly good. We have enough growth to sustain higher stock levels, so I think we'll see stocks go up this year, bonds be more or less in a trading range, I think just because they'll be a little burdened by the supply of treasuries. And I think that'll keep the yield spreads of corporate bonds narrower to treasuries than we traditionally think. And I think when you value stocks by looking what the yield is in the 10-year treasury, you're going to miss a little bit because I think treasuries are going to be somewhat higher than they would be if we had a so-called normal market because of the very, very high supply we have.
There's one theme that will never fail us, and Alex, I think we can always have this in our back pocket, is the election coming up. And I think it would be an interesting thing for you to talk a little bit about how you see these trends developing in the second half of the year, bearing in mind that I think it's pretty safe to say that we're all gearing up for a very hardly, closely fought election.
Yes. Well, I thought coming into the year that the first half of the year would be very choppy up and down and not really make a lot of headway either way. It's surprising with how well we've done in the in NASDAQ and Standard & Poor's up well over 6%, Dow Jones up maybe close to 3%. So that's a little better than I would have thought at this point. My thinking is we may still chop around with worries about slower growth, inflation, or whatnot. But typically inflation in election years are good years for the equity market. So I think in the second half of the year, maybe towards the end part of the year, we should see a rather strong rally into the finish, regardless of which candidate wins. Because I think that it'll just reflect the lack of uncertainty and the fact the economy still has a lot of sustainable growth. I think that's what people missed in looking for weaknesses as the Fed raised rates. The economy is in great shape. There's no sector that's really out of balance. So I think the growth should continue.
But to your point, also, Jen, if you played the themes the last election, they didn't do anything for you. Like clean energy stocks fell after President Biden went in office, despite the IRA, for example, right? So even if you play those themes, it doesn't always work out.
Yeah, I mean, you can have a theme, but what it does for you is a separate question.
It's a very different story, yeah. Hey, Margie, you sound really positive. You sound really bullish. I mean, why would the Fed cut?
Well, because they'd like to cut because they would like to see inflation come down. It hasn't obliged them. I think it's going to be a slow go on inflation. And as I said, they really are aware of the burden that interest rates are going to have as they go higher for financing the federal deficit. It's not a small factor. So I think they have to be well aware of that, particularly when we're likely to continue to have deficit financing as far as the eye can see. And I think they would they feel that lower rates would be healthy, although I can't think of a market where if the 10-year was, say, between 4% and 5%, how that could be considered depression on the economy. I think companies have shown they're pretty resilient. They've restructured the balance sheet, and they're relatively insensitive to particularly moves in short-term rates. And really long rates aren't high enough to derail corporate profits. So we think you really have to be positive. If you look at the history books, you'd say, yes, the Fed is going to cause a recession, but they haven't now in 2 years, and I don't think that they would like to do that. I think they'd like to calibrate their interest rate adjustments to not damage the economy.
Yeah. All right, Margie, thanks a lot. We appreciate it. Thanks for jumping on with us. Margie Patel, Senior Portfolio Manager at Allspring Global Investments. I just find interesting what she said. Like, I was like, what's the next question? And it's sort of like, now what? Like, if everything's kind of humming along, and as Ira was saying, it's not when they start to cut, but for the Fed, how many cuts that they have, we're not going to know that for a long time.
We're not going to know it for a long time. And then with this week in particular, we're really short of catalysts that, that we're aware of, at least that are on the calendar, that can generate a strong move in either direction. So it's all about the next Fed meeting and then the next policy decision.
What's interesting, I like small business optimism. I love that NFIB. It's like one of my favorites. That wasn't great. It hit a 9-month low. And I just kind of wonder how the small businesses are going to shake out as well. Like, yeah, they understand higher rates. Yes, they understand higher inflation. But they're still suffering from all of that process. 39% see business conditions actually getting worse. Just want to put that out there into the universe here. Here's Michael Barr with World National News.
Alex, Jen, John, thank you very much. The special counsel who investigated President Biden's handling of classified documents is testifying right now before the House Judiciary Committee. Lawmakers are hearing from Robert Hur about why he included references to the president's memory in his report. Judiciary Committee Chairman Republican Jim Jordan.
Joe Biden said he took his notebooks with him after his vice presidency because, quote, they're mine. And every president before me has done the same exact thing. Never mind the fact that he had never been president when he took this information. But what comes through is Joe Biden felt he was entitled.
Hur wrote last month that Biden's handling of classified material shouldn't result in charges because a jury would find Biden to be a sympathetic, well-meaning elderly man with a poor memory. Haiti's acting prime minister will resign. The Caribbean Community Organization announced late last night that Ariel Henry will step down once an interim leader has been named. Guinea's President Irfan Ali spoke at a conference in Jamaica.
I want to pause and thank Prime Minister Henry for his service to Haiti, his service to the Haitian people, and for his personal commitment for the furtherance of the development of Haiti and the advancement of the people of Haiti.
This comes amid a surge of gang violence that has pushed the country to the brink of anarchy. Finally, we've learned singer Eric Carmen has died. Carmen rose to fame when he began his solo career in the mid-70s with his hit single All By Myself. In the 80s, Carmen gave us Hungry Eyes. Eric Carmen passed away in his sleep over the weekend at age 74. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom. This Bloomberg Business Flash. Well, it looks like the last mile is really proving to be stubborn. Inflation topping forecast for a second month in February. Got those figures this morning. Seems to underscore the Fed's cautious approach to any rate cuts. So the reaction among investors? Buy stocks. S&P 500 has surpassed its record close from last week. That was 51.57. Other than the producer price index, this is the last major inflation report the Fed's going to see before the meeting next week. Meantime, Mira Pandit at J.P. Morgan Investment Management sees the breadth of market gains broadening out.
This year, we're expecting to see about 40% of profit growth coming from the Magnificent Seven, about 60 from all the other stocks in the S&P 500. And each quarter, that is going to improve until we get into the end of the year, where we're actually projected to see a flip, where you're going to see more growth coming out of the rest of the index relative to the Mag 7.
Oracle right now, the best performing stock of the S&P 500. That is up right now over 11%. S&P 500 up 45 points, a rise of 0.9%. 51.63 on the index. If that holds, this will be another record. The Dow Jones Industrial Average up 243 points. That's a rise of 0.6%. NASDAQ 100, 200 points higher, up 1.1%. Two-year yield, that's up 4 basis points. That's at 457. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. I can say a bit of a head scratcher, but what do I know?
I don't know. More than we do, maybe. I don't know. What do we all know? We're just here.
Seriously.
We're just asking all the questions. What book are you reading again?
It's like 40 years since it was published in, 1972, I think? Robert Caro's The Power Broker.
Here we
So
go.
it's making me really, really mad at lots of things, especially public authorities in New York City.
Excellent. And then you also get up at like 2 a.m. All of this is
Yeah, it's just
piling in one after the other.
Not to mention the congestion charge.
Yes.
It's
Oh,
just-
don't
Oh.
bring that up.
I did it.
No,
I
no,
did it.
no.
You had to.
Quickly, Oracle stock up 11%. So shares are rallying. You got the infrastructure software company reporting third quarter results that beat expectations on some key metrics here. We want to get more with Brody Ford, Bloomberg tech reporter, joining us. Hey, Brody, why was the street so surprised?
There's been a big debate over the last year. Can Oracle transform from this kind of old school on-premise, come to your office and install it on your servers kind of company to really offering cloud infrastructure the way we think about Amazon or Microsoft doing? The last couple quarters, they were disappointing and people were starting to wonder, is this a flash in the pan? Is their growth sustained? Yesterday, they said, hey, no, we actually got billions more in orders than you expected. They had really strong bookings growth. That's kind of reignited that enthusiasm that, hey, maybe Oracle really can be that, fourth hyperscaler after Google, Amazon, and Microsoft.
But I guess, they've been having their ups and downs. Their shares got really badly hit, relatively speaking. And so
Yeah.
do you feel like the recovery today is for real, or what's going to be the next way station that investors have to look for?
So what's convinced them is that when you're offering cloud services, people forget the cloud isn't in the sky, it's in data centers in Virginia. And they need to build them.
That's my quote of the day.
Yeah. And so Oracle said that they're going to spend $10 billion next year just building up these data centers. And keep in mind, a couple years back, they were spending $2 billion a year on CapEx. Now it's 10. That's a real difference. And that's convincing investors that, hey, they are actually building out their physical infrastructure. In the AI era, everyone needs more cloud. Everyone needs more of this computing power. And Oracle does seem primed to actually capture a lot of that demand. So people will be watching whether these data centers do go up in Virginia and other states.
I thought we didn't like it when companies spend a lot of money on stuff.
We like it if it's going to come back and give us something else, right?
Okay.
I mean...
But what's that time? So they're going to invest
Yeah.
all this money. When do they make money off of the money they just spent?
Yeah, it seems like it'd be pretty quick because if you believe the executives on the call, executives grandstand sometimes, but they say that demand outpaces supply. They've been saying this for a while, that with the AI era, everyone's rushing to get more computing power. They can't provide it. So the second these data centers go live, in theory, they should be able to convert that into revenue very quickly.
Are they good at doing that quickly relative to other companies?
They are known for ruthless operational efficiency. There is. So they should be good at this, right? I mean, of course, the market could change, right? Everything looks rosy with AI right now. Everybody wants to train their own models. Could we see a sea change? Hard to say. But yesterday they got 80 billion in bookings. Once you book, you can't get out of it. So at least for a while.
So I also find this interesting if we're going to see cloud computing and AI be a cyclical industry or not. Like clearly it's a structural shift, but will we see a ton of data centers come on at the same time, like from different companies, and then therefore prices go down so the revenue isn't as hot? Like will it be cyclical like chips are, for example, or not?
It's a good question. There's one rule of software compared to hardware, that software is a lot stickier, right? I mean, you buy chips, you have them, you don't necessarily need to buy more. Once you start giving money to software providers, you plan on X amount of computational power, that usually doesn't go down. I mean, is there a point where the growth will level off? Probably. I struggle to see it being like hardware where, hey, everybody bought computers this year, now the computer makers are SOL because nobody wants to buy anymore.
And then it's all, they've got you on the subscriptions, basically, like what we all have at home. But now, can you talk a little bit more about how Oracle is benefiting from AI?
Yeah. Well, and that's the big question for a lot of software makers. Every software maker, when they have positive results, they say in their commentary, this is due to AI.
That could be anything.
Right. They call their new cloud version the Gen 2 AI. Is everybody using it for AI? No. But what we know is that AI requires a ton of computing power, and Oracle has marketed theirs specifically for being good at training AI models. And so there's reason to believe that folks are upping their demand due to AI needs. But is this more than a couple of percentage point difference? Most analysts don't think so at this point.
So it's still the cloud. It's the cloud, the data centers, building all that out.
Yeah, think about any companies running all these records, the terminal, anything like that. Just it's more that kind of traditional stuff at this point than it is training models, though. That's probably part of it.
I did want to point out too that maybe you can comment on this one, that Bank of America, reason why they upgraded their earnings in part was because of an investment cycle from big tech, Microsoft, Amazon, Google, Meta, spending $180 billion in CapEx. They're in that reinvestment cycle, and I'm assuming guys like Oracle are going to be beneficiaries. Is that a link I can make?
I think it is probably more that they're all riding similar trends. Amazon, Microsoft, they've spoken also in recent quarters that their customers are really focused on cutting costs, that for the most part, everybody had transported a bunch of things to the cloud, and then they wanted to cut costs. And that behavior was starting to change. The 2024 budgets got approved. They started feeling good again. And the investment was going up. And so I think it's more that they're all riding a similar wave.
I see.
Let me ask you something internally about Oracle. Who's running the company? Is it Larry Ellison?
It's crazy, right? Because you think about somebody like a Bill Gates, that's the same generation. He hasn't been there for a decade or more. But yeah, Larry's still running that. I mean, his title is not CEO, but he's chairman and he's CTO. He's, on the earnings call talking back and forth with analysts. For someone of his age and his generation, it's rare to see him still running the company, but he continues to, and there's no reason to believe that will change anytime soon. So it's interesting.
What's the deal with that, though? I mean, why is he still around?
I mean, you found a company, it's your life. And for the most part, investors still like him. People still see him as this kind of tech visionary type. Every single analyst day, he takes questions for multiple hours. It always goes over time. It's almost like the, Putin's annual address when he goes with the reporters.
It's a great comparison. We definitely want to live with that comparison. It's fair enough. But nonetheless, I do feel like the cloud is not in the sky. It is in Virginia.
In data centers in Virginia.
Might be the best line I've ever heard. Which, funnily enough, yesterday when EQT bought the midstream company, they did say that. They're like, all the data centers are going to be built in the South, and we need the natural gas to power them, so we're going to help send that there. That's a narrative that continues to be building within that. Brody, thanks a lot. Brody Ford, Bloomberg Tech reporter. Super enjoy your commentary. That was really helpful, I have to say. Cloud infrastructure conversations can really, really daze me. I did not get dazed on that.
I did not, because Brody knows his onions, as they say.
and he knows where the cloud is, not in the sky in Virginia. All right, looking at a market here, hanging in just fine. NASDAQ is up by about 1.3%. A nice move on the highs of the session there. S&P up by 1%. This is Bloomberg.
your company news headlines on Bloomberg Radio.
And I'm John Tucker in the newsroom. We'll look at some of the company stories we're following today. Now, according to the Times, a six-week audit by the Federal Aviation Administration of Boeing's production of the 737 MAX jet found dozens of problems throughout the manufacturing process of the plane maker and one of its key suppliers. For the portion of the exam focusing on Boeing, the FAA conducted 89 product audits, a type of review that looks at aspects of the production process. The plane maker passed 56 of the audits, failed 33 of them, with a total of 97 instances of alleged non-compliance. Porsche expecting weaker returns this year. That's because of the costly rollout of new models and high development spending in a challenging global economy. Porsche has flagged 2024 as a transition year with a record 4 new model launches weighing on their sales and profit. And the Body Shop ceasing its U.S. operations, closing dozens of locations now in Canada amid deepening financial struggles for the British beauty and cosmetic chain. The Body Shop's U.S. arm ceased operations back on March 1st, according to a company announcement from earlier this month. And the brand's Canadian subsidiary commenced liquidation of 33 closing stores as part of its bigger restructuring. How many times in the middle of the night have you gotten up? Well, you have kids, so stepped on a Lego in the middle of the night?
No, I have a cat. I have cat toys now.
Oh.
That's even more of a pain.
Well, mine were Legos. Anyway, Lego has beat its biggest toy maker competitors, capturing market share even as its largest rival, Mattel, was buoyed by, yes, the Barbie movie. Go Lego. And that's a look at some of your company stories. I'm John Tucker.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
You're listening to Bloomberg Intelligence. I'm Alex Steele here with Jen Ryan. This is where we cover all the top news and analysts from our top voices all around the world. Bloomberg Intelligence analysts cover 2,000 companies in 130 industries worldwide. Speaking of, we're going to go to Michael Barr now for world and national news. Michael?
Thank you very much, Alex. Jen, John, President Joe Biden repeatedly told a special counsel he never meant to retain classified information after he left the vice presidency, but was at times fuzzy about dates and the paper trail for sensitive documents. That's from special counsel Robert Hur and Biden's interviews. Hur is testifying right now before the House Judiciary Committee about his investigation into the handling of classified documents by the Democratic president.
The evidence and the president himself put his memory squarely at issue. We interviewed the president and asked him about his recorded statement. Quote, "I just found all the classified stuff downstairs," end quote. He told us that he didn't remember saying that to his ghostwriter.
Hur concluded in his report Biden should not face
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that I start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
Welcome to the digital age. Are you struggling to stand out here? Don't worry. Meet Blue TV, who is your digital superhero.
Blue TV is a multi-purpose online media network that also provides digital marketing services. We are based in Islamabad, Pakistan. We are expert in creative marketing, social media and digital marketing, search engine optimization, web design, page rank, and SERPs, video editing, recording and production.
So, what are you waiting for? Pick up the phone and call or WhatsApp Blue TV on given number, or visit our Facebook page at facebook.com/blue.online.tv.
With Blue TV, your business growth will be skyrocketed.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down the path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to like build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
Fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Tuesday, everybody. Well, except if you own airline stocks, because it's a kind of rough day for all the airlines, particularly Southwest. We're going to talk about that with George Ferguson of Bloomberg Intelligence. He covers aerospace, defense, and airlines. We'll break it all down with him in just a moment. I'm here. Paul Sweeney is on vacation. Jen Ryan is here as well as John Tucker, who's going to join us now with our business flash.
That's right. And stocks are higher. Treasury yields are higher. Treasury prices lower. Right now, the S&P 500 is on track for a record close if this keeps up. This all comes as the consumer price index came in hotter than expected. So the market may be analyzing what we call the super core data. That focuses on the price of services and strips out energy and housing. Super core CPI rising 4.3%, coming down from 6.1% a year earlier. Morgan Stanley equity strategist Mike Wilson, he was on the program earlier today. He says, you know what? AI-related stocks have yet to reach their full potential.
The real opportunity, though, is going to be when this technology diffuses across the economy. And that would be the adopters. And that's very, very early days.
Bank of America strategists, meantime, raising their S&P 500 earnings forecast, citing resilient economic growth and artificial intelligence breakthroughs. Right now, the S&P 500, 46 points higher, up 0.9%. We're at 5164 on the index. The Dow Jones Industrial Average up 236 points. That's up 0.6%. The NASDAQ 100, 200 points higher, 1.1% higher right now. And as we look at yields, the Treasury yields, the benchmark 2-year, the 10-year benchmark, that's up 4 basis points at 4.14. The 2-year is up 5 basis points right now at 4.6%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash, Jen and Alex.
Thank you so much, John Tucker. Nice ringtone, by the way.
Now, somebody's messaged me.
Did you guys hear that?
apparently,
It was
saying I
very
did something wrong.
Superman kind of thing. Okay, so as John Tucker was pointing out, looking at a market that's doing pretty well, I have to say, Jen, I wouldn't have thought we'd see this much of a bullish reaction in the equity market, considering that you did still see inflation up versus the forecast. Lower, sure. Trajectory, sure, but still.
But still, indeed. I mean, this was not a screaming, vote for a Fed rate cut straight away. I mean, the meeting was like a lot more subtle than that.
I totally agree with you. All right, let's get to Abigail Doodle now. She joins us to cover all things markets. Abigail, what are you looking at today? What's on your radar?
Yeah, I'm a little surprised by the degree of the gains at this point, especially given the fact that we have yields near session highs, up about 6 basis points for that 2-year yield, in sympathy with that warmer CPI print. I think, though, that investors are relieved that it wasn't worse than it could have been, that it didn't pop up, a couple tenths of a percent.
Also, I wonder if there was positioning around certain levels.
Yeah,
I don't
that's
know,
a
but
good point.
I mean, maybe, I don't know. No one seems to be hedging downside anyway, but you never know.
Yeah, no, that's an interesting point, and also the point that you were making last hour, a little bit of selling into the report, so now buying that little bit of a dip. At this point, we have the S&P 500 up almost 1%, the NASDAQ 100 up more than 1%. Let's see what Apple is doing. So Apple is actually, so it's interesting. So Apple yesterday finally getting a bid up more than 1%. Right now, down about 0.2%, but because of its weighting to the S&P 500, it's the biggest drag on the S&P 500. So when you take into account the fact that the overall market's up about 1%, one way to look at Apple, well, now it's switching over to Boeing. We can, of course, talk airlines more broadly ahead of your conversation with George Ferguson. But Apple, you could almost look at that as a 1% decline or a 1% spread to the S&P 500. It's a more accurate way to put it, which suggests that maybe Berkshire Hathaway is still in there. That selling pressure that seemed to not be there yesterday has perhaps tiptoed back in today, something to keep an eye on. Another stock that stands out to me is NYCB, up 3.1%. The news is that Steve Mnuchin, the Mnuchin-led investors, I should say, that deal has closed for the capital infusion of more than $1 billion. So let's see whether or not they can get things together. The new CEO, there seems to be the sense that yes, I think that they may make it as they kind of try to pare out some of the commercial real estate loans and clean things up otherwise, and also perhaps bring themselves below that $100 billion mark for some less regulation. So I think those are all the things that stand out the most to me right now.
Can you talk a little bit more about sentiment around the financial services? Because, you've seen this deal close with NYCB, and we're 1 year on from the run on SVB.
Yep.
So how has sentiment developed more recently in that sector?
So I think that in general, when the NYCB situation started to develop at the end of January, the big question is this a broader call on the regional banks, or is it idiosyncratic? I think that the net feeling, and this may actually be a reason for pause, is that it's probably a little bit more idiosyncratic. I do some work around the commercial real estate space, and about 25 of the regional banks, the largest ones, they have maybe call it 14% of their commercial real estate loans. The smaller banks have 44%. So it's likely that we will see some more blowups of the smaller regional banks, but the bigger ones apparently are capitalized well enough. So one person I was talking to who's been following the regional banks for decades, he said that he thinks that it's not going to be hundreds or thousands of banks that we're going to see problems with. It's going to be maybe a dozen, maybe not even 24. And there are a lot of folks out there who really like the big money center banks, your JP Morgan, Citigroups, and the like. Something really interesting to me is that from the date of the Silicon Valley Bank blowup, so basically a year ago, the KRE, and I just want to make sure that I'm correct on this, that regional banking ETF, it is up, I believe, more than 10%, which it's up 11%. So that kind of tells you that the sentiment has really changed in a dramatic way.
That's interesting.
Yeah.
Well, what's on your radar for the rest of the day? Like, we're winding season down. That's not a sentence. We're winding to earnings season down. We have retail sales Thursday, but I feel like after CPI, it's gonna be meh. Like, what's the stock you're gonna be watching for direction at the moment?
For me, it's always going to come back to Apple, because as goes Apple, goes the market. Although that's not been
true.
Maybe,
yeah.
Well, yeah, for the last 3 or 4 months, that hasn't been the case. So if it proves the case, and I'm a big fan of this time is not different, it means either the S&P 500 is coming.
Today, I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need. Like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Ratio.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
From the UK, and I'm the inventor of the gel razor. And today I'm looking for an angel investor to fund my project, the gel razor, whether that's a working concept and working prototype, or manufacturing possibilities with investment, or to get me a licensing deal secured. If you go in any supermarket today, you will see packets of razors sold separately with tins of mousse or gel. Hence I did that all in one. The idea is you pressurize the handle. The gel flows through the reservoir up to the head of the razor, coating the blade, ready for the shave. My target market is 18 plus, male or female, male blue version, female pink version. What I'm looking for in an investor is someone who's passionate, determined, shares my vision. That's an important step for me, and willing to succeed as I wanted to succeed myself. Patented in the UK in 2021 September with copyright protection. I have a logo for the gel razor, which you will see on my LinkedIn profile. Currently working with a company in the US who have done me a lovely sell sheet. Big up to them guys. So if you're interested, contact me on LinkedIn profile, Paul J. Gwilt, GWILT, or email me at mufc219@gmail.com.
Month to month after a 0.5. So I still think underlying core inflation is a bit too strong. Market probably will wake up to this over the next few days.
Okay, so market wakes up to it. I appreciate you're an economist, but what happens? Like, we've already seen some selling across the bond market. We've seen sort of the back end catch up a little bit here with yesterday's selling in the front end. What's going to be the ramification?
Yeah, I think higher bond yields across the curve. Implication would be, pricing of fewer cuts, pushing out the timing of cuts. That could also have an impact on risk assets, equity prices, credit spreads in the bond market. I think that could ripple through as well. So, really, it's the bond market that is the key driver here of everything else. So the implication is higher bond yields for longer.
So now I want to ask you about a theme that, Alex and I were discussing this earlier, and we had some guests talking about the election coming up this year. How do you see things developing in the second half and indeed in the second quarter, or the fourth quarter, I should say? Because if you've only got 2 rate cuts, one of them's going to have to come either immediately after the election or in December. And so you must have a very particular view about what sentiment around lower interest rates is going to be at that time.
Well, I just think back to 2016. We saw a rate hike at the end of the election year. There's been some other instances. 2018 we had 4 rate hikes throughout the year, despite that we had midterm elections. I think investors like to talk about elections. They love to talk about politics, but really, I think it's going to be the inflation trajectory that determines what happens with interest rates, not the election. So really coming back to that path for core inflation and then ultimately the destination. If we're right that the path is bumpier and we end up with higher core inflation at the end of the year than the market currently expects, then we'll get the fewer cuts. The Fed funds rate will end up being higher. I think that's the key story. The election, what happens there is not, I don't think it's going to change that. Now for 2025, that's where the election really matters, right? Because that could change the tone of fiscal policy in the coming year. So I do think if the Republicans take back the White House, then you could have a more aggressive or expansionary fiscal policy in 2025. And again, that could have some bond yield implications, but it's probably a story for late 24 and into 25.
All right, but put that aside for a second. So you see 2 this year, and then how many cuts then are you sort of mapping out for 2025? Like the whole rate cut cycle?
I think it's possible that you could see one, sort of a pace per quarter in 2025 of 1 cut per quarter. So you get an additional 3 or 4 in 2025, something like that. So certainly no slashing of the Fed funds rate, not anticipating on a 12-month horizon a recession. So I guess this would be more similar to what you saw in the mid-1990s, where we had, the early 1990s, the Fed hiked a lot. Rates went up a lot, but the economy continued to grow throughout that decade. So the Fed funds rate stayed in a pretty narrow range from, say, 1995 until late 1998. So
and there's
I think something more like that.
There's no dramatic fall off then in that perspective.
The question is, how would you get a dramatic fall off? To me, it has to be an economic downturn. It has to be a recession. So you have to have that in your forecast. We're more upbeat. We think the economy will continue to grow out over the next year.
He does seem upbeat, doesn't he?
He is very upbeat.
Even like looking at him on YouTube, like his energy is like he's into it. He's stoked.
From California, the California vibe here.
This makes sense.
The good weather.
Yeah,
I know. But now, look, let me ask you about consumer sentiment, because there's the inflation squeeze pinches everyone's pockets, and yeah, inflation is easing, but the prices are still a heck of a lot higher than they were before. And this is something that we've been well established has been weighing on enthusiasm for the Joe Biden economic program. So how do you see consumer sentiment developing?
Well, just talking to virtually, all clients, they say, hey, Jeffrey, you saying that inflation is cooling off, but, I still see prices elevated at the pump, or I still see expensive food prices. So, I mean, the difference there is just rates versus level. Central bankers are focused on the rate of inflation. I think the average consumer is focused on the level of inflation. So that's the disconnect you see. As a result, that's weighing on consumer sentiment. And so that's just a fact. I don't think there's any way around that. But this was brought to the attention. He already knows this, but Jerome Powell was asked about this last week on Capitol Hill, and he said, "Look, we're not expecting to see price level fall, the average price level fall. That only happens in very adverse, economic scenarios like a recession. What they're trying to achieve is a slowdown in the rate of increase, trying to get that back to 2%. But we've already talked about there's problems even then. I think inflation is a little bit stickier even on that slowdown.
All right, really good stuff. Appreciate the positivity. Jeffrey Cleveland, chief economist at Payden & Regal, he joins us there. But then on the flip side, you have Morgan Stanley's Mike Wilson says he doesn't see a need to raise the S&P 500 target. There's no justification in the absence of broad earnings growth. Now that is in contrast with an idea that maybe it's okay. Like we're not going to need a huge downturn in order to get Fed cuts. You can make do with 5, maybe 6 for the total cycle.
I mean, going back to the 1990s, rates around 5% or so, that's very long way from what it was at 12, 13% or what have you. And so if you think, where are we right now? This is definitely an area that we can live with.
Yeah. I was in high school in the 90s and college. I don't really remember that much. Although I did think Capital One credit card interest rates were too high. But I still would think that now, I think.
She was nice. I was here already. I was on my 5th job.
I don't know where
I mean, to be fair, I was working as a waitress, so, you know, I did have an income.
I was a waitress as well.
There you go.
There we are.
This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg News with this Bloomberg Business Flash. Risk on today, even though core inflation surprised to the upside for a second month with the consumer price index that we got this morning. But the so-called super core gauge, that actually slowed to 0.47% of the month. That's down from 0.85% in January. The stocks edging up after the data did little to alter bets that the Fed's going to be able to cut interest rates this year. Treasury yields rising across the curve and also the dollar strengthening. In the S&P 500, 8 of the 11 major industry groups are higher right now, being led higher by information technology, and that's where you're going to find shares of, yes, NVIDIA up right now close to 6%, and the S&P 500 on track for a record close if these gains hold up. S&P 500 50 points higher, up 1% at 5168 on the index. The Dow Jones Industrial Average up 240 points. That's a rise of 0.6%. The Nasdaq 100 right now up 1.25%, up 225 points. The 2-year yield, that's higher, up 5 basis points, close to 6 basis points right now at 459. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Jen and Alex.
Thank you so much, John Tucker. When was the last time anyone flew Southwest?
No.
It's been a minute.
Not for ages.
It's been a long minute.
When was the last time I flew anything?
Okay, fine. So maybe John Tucker's not the right
beach.
person to talk to about this. Southwest, so ticker LUV, is down 14%. So the company plans to cut capacity this year, halt most hiring, and review its spending plans in response to reduced aircraft deliveries from Boeing. Here's my question. Is this going to be as simple over the next year? All the airlines are going to raise their fees, and they're going to say, it's not our fault. We got to cut capacity because of Boeing. I wonder if that's what we're going to hear. Well, joining us now is George Ferguson, Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst. George, is that the thing? Let's just blame Boeing for the things and then raise our prices?
Well, so not everyone will be able to blame Boeing, right? So there are airlines that are operating Airbus aircraft, companies like Delta, JetBlue, Frontier, Spirit. They won't have the problems that airlines that are being supplied by Boeing will have, and they'll look to put as much capacity in the marketplace to take advantage of the fact that the airlines that are flying Boeing product aren't able to get all of the flying done that they want to do. The truth too here is I think that the Boeing challenges will provide a little bit of firmness to the marketplace. But I still see, I think, a U.S. airline market that looks like it's got has plenty of capacity in it. And I still think fares are flattish to maybe going down for the year unless Boeing really curtails their deliveries for the year.
Yeah, it's interesting because if I read this issue about Boeing and I read this cut in capacity, but my first thought is going to be that means higher prices for consumers. So what accounts for the difference there?
Well, first of all, I think the U.S. market already had sufficient capacity last year, right? I think we're bouncing back from a pandemic. We saw a bunch of sort of revenge travel, earlier in this bounce back. And that was very leisure driven. I don't think we're going to see as much of the leisure driven travel this year. Not the I got to pay whatever it's going to take to get down to Disney. So you'll see maybe a smaller growth amount in leisure. And business isn't fully back. We know that. So we've got more than 2019 levels of capacity in the marketplace, less business, and maybe a little more leisure. So when I add that all up, again, I kind of see a market that looks like it's got plenty of capacity. If you look at the guidance that Southwest gave on revenue per available seat mile, they lowered that at this discussion. So it tells me that the market is weaker, at this guidance point. The market is weaker than they initially thought. And at the same time, fuel prices were a little bit higher. So what it looks like to me is Southwest numbers are going to come in lighter than we expected in 1Q. That's not a super healthy market. That's not a market that's got so much constraint that they can price whatever they want to for airline tickets and make lots of profits.
Okay, so it's like a trifecta. Like they do have a specific Boeing issue, and the fuel prices, and then the broader softer market. That's a general airline issue. United also told Boeing to stop building 737 MAX 10 jets for the carrier. Okay, that sounds dramatic and bad. What does that actually mean?
I think it sounds like Scott Kirby, the CEO of United, is just getting real about what he thinks Boeing can deliver in the near term. I guess, if you sit around and you kind of hope and hope and hope they're going to get the MAX 10 certified, and you wait on those deliveries based on that hope, and the certification keeps getting pushed out, and it's really hard to plan. So Scott Kirby said, hey, look, stop worrying about the Dash 10, just bring me Dash 9. He was saying, look, I just want airplanes. Bring me airplanes. I think the market's generally going to be strong for me. He's in the premium segment too, right? Which I think from the guidance we saw today from airlines, premium is holding up better. So he wants airplanes. He wants to go out and find some of those 321 larger scale from Airbus. Again, I think it's okay. I think Scott's being a realist. There's a lot of challenges right now at Boeing, and it feels to me like certification for the Dash 7 and the Dash 10. The Dash 10 being the biggest variant of the 737. There's just almost no way they're going to get pushed out longer than when we expect, given the problems in manufacturing at Boeing right now.
And what is that? So, is there any read across that we should start thinking about for Airbus?
Well, I mean, here's the challenge of this industry, right? The read across is, look, Airbus ought to be able to go get a lot more orders for its Airbus A321. But the problem Scott has, and he's a really good customer, and they're working hard to find him slots, is that they probably can't get him 321s for 4 or 5 years from now.
Wow.
So that doesn't fix his near-term problems. And customers that would be smaller than United have an even larger problem because Airbus isn't going to work as hard to try to get them into the delivery cadence. The industry is operating at sort of max capacity now. It's pushing its supply chains to do better, but we just don't see increases of build rates kind of more than 10-ish% per year at best. It's really hard to bring up that supply chain. So I think the duopoly means that Airbus can't really capitalize that well on this.
Just anecdotally, I flew to Houston for like a day last week, and I flew there on a new Boeing jet for United and back on an old one. And man, that was different. That was a very different experience.
Did you bring a wrench with you?
Okay, I did text my husband, and I was like, hey, so I'm on this Boeing plane just in case something happens. I know, I'm like that. What is the floor, though, George, for Boeing? I mean, the stock is literally dropping like a knife here. Are we looking at the October low is what we have to be watching? Like, where's the support, and where is the support going to actually come from?
So, look, it's, Boeing has been through some real troubles, and the bad news sort of keeps coming. Look, it's hard to say what a price would be on that floor. I will say that I think their purchase of Spirit that they've proposed could start to put a floor underneath their problems. I see that direct line of management from the Spirit floor in Wichita, Kansas, all the way up to Boeing in Renton, Washington, as being the ultimate solution to improving quality, oversight. So I think we have to watch that development closely. It's going to require getting some of the Airbus business outside of Spirit because Spirit builds products for the A320 for Airbus and the A350. I don't think you want that inside Boeing. So this is going to be a complicated procedure, a complicated purchase. But I think that's the beginning of Boeing really getting to stabilize their builds, improve quality, and that's going to make the FAA free up FAA time and open the FAA's mind up about certifying MAX 7 and 10. So I think that's the beginning of it.
I mean, if you think about what the challenges are facing Boeing, is there much of a difference to the company if we get a soft economic landing, a hard economic landing, or no landing?
Honestly, I think for all the airframers, there isn't, right? So, again, Airbus and Boeing building aircraft at rates much lower than their customers are demanding right now. Customers like Scott Kirby want to come in and buy A321s next 3 or 4 years, can't get them. So I think even in a hard landing, soft landing, no recession environment, these folks just keep working on making the supply chain better so the supply chain can put more of the components on the factory floor and build more aircraft. Although I would say maybe in a harder economic landing, it might free up some of the labor that they need and keep some of the labor more stable at their suppliers. And that's really the challenge right here is labor at the suppliers, stabilizing it. You need smart people there who've been doing the process for a long time so they do it right all the time, know the right processes and procedures.
Hey, George, if anyone listens to the show or watches TV with me, I am a deal person. I like me deals. I like all the deals, whatever the deals. If I want to look for deals for flying, where am I going to get that? Like, is it literally going to have to be sort of regional companies exposed to Boeing? Like, am I going to have to get that granular here?
Well, no, right? So the way I mean, airline seats, all the CEOs would complain that I say this, but I really find them largely as commodities, right? And so if you're going to find lower fares, I think you're typically going to find them lower across the board. We are seeing, you know, it does seem to me that non-premium leisure is an area of especially good, you know, a lot of seats available, especially good prices, maybe the further down the curve you go on it, you may not want to go that far down to the Spirits and Frontiers would even be some of the best deals. But, you know, Southwest guidance today means that even in a nicer, you know, non-premium product, they're still having challenges getting fare, and so I think that's important. That's good.
Oh man, fine. George Ferguson, Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst. And let's be fair. I mean, like, I want to sit in the front of the plane.
Who doesn't?
I mean, you know.
You want to pay. You want first class, but you want to pay coach.
Boom. He gets me. Michael Barr's next. World National News.
Thank you very much, Alex. Jen John, the special counsel who investigated President Biden's classified documents case, is on Capitol Hill testifying right now before the House Judiciary Committee. It's been spirited. Robert Hur has been accused by Democrats of inserting an unnecessary opinion in his report about the president's memory and mental acuity. Hur, in his opening statement, defended his language in the report and says that he had to make a judgment call about the president.
The department's regulations required me to write a confidential report explaining my decision to the Attorney General. I understood that my explanation about this case had to include rigorous, detailed, and thorough analysis. In other words, I needed to show my work.
Meanwhile, Republican Jim Jordan, Judiciary Committee chairman, charged Biden knew what he was doing.
Joe Biden had 8 million reasons to break the rules, took classified information and shared it with the guy who was writing the book. That's why he did. He knew the rules, but he broke them for $8 million in a book advance.
Democrat Jamie Raskin, ranking member of the Oversight Committee, countered. He brought up former President Trump, who also had classified documents.
Most notably, after being given multiple chances to return classified documents and avoid prosecution, Mr. Trump allegedly did the opposite. According to the indictment, he not only refused to return the documents for many months, but he also obstructed justice by enlisting others to destroy evidence and then to lie about it.
Democrat Jamie Raskin. Both President Biden and former President Trump are expected to earn enough delegates to clinch their party's nominations today. Primary contests will be held in Georgia, Washington State, Mississippi, and Hawaii. Haitian Prime Minister Ariel Henry has announced that he will resign once a traditional presidential council is created. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg.
events, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash, being brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with the solutions they need to grow a thriving business. Commonwealth, go where you grow. Visit commonwealth.com to learn more. Lots of green on the screen. Stocks heading higher despite that hotter than expected inflation print. But that PCI reading hasn't meaningfully altered bets that the Fed's going to cut rates this year. The S&P 500 right now on track for another all-time high. And tech shares, they are leading the gains. You have NVIDIA up just about 6%. Well, despite some worries about a correction, Brian Levitt over at Invesco isn't shying away from stocks.
Yeah, I'm all in. I mean, there's a 5 to 10% pullback every year, right? And so this year is likely to be no different. And when do those pullbacks come? They don't emerge out of nowhere. They're almost always the result of policy uncertainty.
Well, the Fed does meet next week, and futures pricing in nearly 70% odds the central bank will start easing in the month of June at their meeting then and enact at least 3/4 point cuts over the course of this year. The S&P 500, 44 points higher. That is up about 0.9% right now. 5162 on the index. The Dow Jones Industrial Average is up 216 points. The NASDAQ 100 up 193 points, up over 1%. 2 points higher. That's at 459. The 10-year also 5 basis points higher, and that is at 415. And we check the markets for you all day long. Right here on Bloomberg Radio, I'm John Tucker, and that's your Bloomberg Business Flash. Jen and Alex.
All right, thank you so much, John Tucker. One other stock that we're watching today is Kohl's, ticker KAS, or KISS. That stock is down by about 2.5%. Its operating margin forecast for the year did trail consensus estimates, and the midpoint of its annual earnings target range also fell short. To be honest, I've been to a Kohl's once in my entire
but
life.
they send out the Kohl's Bucks, which, big discount. I'm surprised at you. You don't get that in the mail?
No.
Kohl's Bucks, they're like little, discount dollars.
I mean, I appreciated the store when I went in there, but when I ordered a pair of shoes for my daughter and they came in completely the wrong size, there's a small chance I misunderstood the size. But let's just blame Kohl's. I've been there once.
I've never been.
Wow. Tucker?
Oh, yeah.
Oh, he is the butt. This is where Tucker shops.
My pants? That's from Kohl's.
Maybe this is Kohl's problem. All right, let's get more insight.
I beg your pardon.
They need Jen and myself to go there.
I
They
see.
need us to go shop there.
Nobody would shop at a place I go shopping.
No, just that they also need us to go. All right, Mary Ross Gilbert, Bloomberg Intelligence Senior Equity Analyst who covers retail, joins us now. Is that the problem? Jen and I need to go shop there, not just John Tucker?
Well, Jen and Alex, they do have Sephora, and I'm sure that Sephora carries the brands that you care about. So Sephora has been a key driver for Kohl's, and that's the reason why their sales aren't that bad. If you look at the comp sales, they fell 1% in the quarter at the stores. So total comp sales were down 4.3%, worse than consensus 3% estimate. But digital sales were down 10%. And now going forward, after we get beyond the first quarter in 2024, we should see the overall comp sales do better. One with the Sephora initiative, because the comparable sales for Sephora was up 25% in the fourth quarter. So we've been seeing double-digit increases there. So that will help, but there's a number of other initiatives, including the news today, that they're going to be putting Babies R Us shops into about 200 stores by the fall. And that really fills a void in the market. I'm sure you're aware that, wow, what happened with Bye Bye Baby? And what about, remember, Toys R Us? That used to be a go-to place when you were expecting or had a baby. You could go there, get your strollers, get all your products there. So that will also help be a driver, and along with a number of initiatives that they're working on, including the home category.
But I guess if we talk about what's good in their future, it sounds like it's a lot of stuff that is not Kohl's. It's Sephora, it's Babies R Us. What's the issue with the fundamental core Kohl's offering?
So they're revamping the merchandise because that was part of it, is just not having the right assortment. So they're redoing shoes, and they're going to be bringing in Skechers. They already have Nike, they have Adidas. And now you're also going to see them bring in some youth brands. So they're going to bring in Quicksilver, Aeropostale, Madden, Limited 2, and Roxy. So those are also going to be helping on the apparel side. So with the overall revamp that they're doing on apparel, and some of their private brands are actually, they resonate pretty well. Like in babies, they have Jumping Beans that does really well. So it's really a host of a lot of things that they've done with the stores. If you go in them now, they're a lot brighter. The culture there has really been boosted. We've noticed a difference just from a year ago on how much the stores have been transformed. And so that's helping.
Yeah, that's so interesting. When I went and I was looking in, kids grow like weeds, right? My daughter's 9, so I was looking for pants. And I was like, oh my God, they have Nike? I was like genuinely like, I had lots of those moments whilst walking around.
I'm going to have to check it out.
It's also a place where I think you could still bring back your Amazon stuff.
Yes.
So
Yes.
that's
I've
the
seen people
point
do
of
that too.
return.
But that's an
That's
excellent
right.
point. So, okay, we're listing the good stuff. So, Mary, why is the stock down 2.6%? Like, I just feel like it's getting beat up a little bit, and I'm wondering then the why.
So you raised a good point. You brought up earlier that they're going to be missing consensus estimates for operating margin next year. And part of that is because we had a new ruling that came out from the Consumer Financial Bureau saying, okay, we're going to cap late fees on credit cards to $8. So when that's going to have a negative impact for department stores generally, because they tend to have the biggest exposure. And so Kohl's is one of them. They generate a fair amount of income from their credit card portfolio. And so they guided today that that income will be down mid-teens. And that's about 135-ish million is what we're estimating the impact this year. And that's not the full year impact. But they introduced a co-branded card. And in 2025, they hope to be able to offset the loss of income that they'll experience. But we'll see. But that's one of the reasons why you're going to see some pressure on the margin side is due to that that ruling that came out.
So what's the consumer favorite these days? I mean, we see you've listed all these interesting brands turning up at Kohl's, but is that enough to get the consumers through the door? Or, can you think more broad? Can you tell us a little bit more broadly about the retail space? Are there other shops that consumers are preferring these days?
Yeah, well, clearly off price. And when you think about what's happening here with Kohl's, they're buying more frequently, which is more of an off-price strategy. All the buying occurs on a weekly basis. Tom Kingsbury, who's the CEO, he is the one who turned Burlington stores into the fast-growing off-price retailer that it is. So he lends a lot of credibility, and a number of the initiatives that he's already employed is already demonstrating improvement. And so, yes, you're seeing the consumer, especially the consumer that's attracted to Kohl's, they also shop at off-price. And off-price has been a big winner for that value consumer. And then other retailers that are doing well are those that are executing and really delivering on the merchandise. And so I'm speaking to apparel retailers like Abercrombie, Urban Outfitters with their Anthropology, and their Free People brands. So it's kind of a tale of two stories. Those that are executing are delivering on results. And here we're in a transition phase at Kohl's, and they're hoping to be able to turn the tide of declining sales for this department store operator. And they do have one benefit. They're off the mall, not in the mall. And that makes them different. So it's easier to get into the parking lot, get into the store, and get out again. So it's easier access. And like you pointed out, they have Amazon returns. It's not additive to sales, but it does bring in traffic.
True.
And then more importantly, Sephora has been the biggest driver.
True. Really good stuff. Really appreciate that. Mary Ross Gilbert, Bloomberg Intelligence Senior Equity Analyst covering retail. Right. You go return something, you go buy something. I mean, that's literally my mom's entire life shopping.
It's a very solid business strategy.
I'm just going to return it, and then I'm going to buy something when I'm also there. All right, you're looking at the market. Still very positive rally here. NASDAQ up over 1%.
your company news headlines on Bloomberg Radio.
And I'm John Tucker with a look at some of the company news that we're following. This is an important one. This is from the Washington Post. Biden administration officials demanding today that United Health Group take more steps to stabilize the health system. This follows a national health payment crisis. So hospitals, doctors, and other healthcare groups say it's threatening their ability to fund their businesses and provide care. Change Healthcare is a subsidiary of United Health, the nation's largest processor of medical claims. They've been offline since a February 21st cyber attack. So this is actually crippling payments to tens of thousands of hospitals, physician groups, and other organizations. So the Biden administration has pleaded with United Health to accelerate emergency funding to affected providers and be more transparent. Home Depot expanding its marketing efforts with a 3-year NCAA deal that will be timed to begin with March Madness. The deal includes advertising rights for 90 NCAA championships, including the women's and men's Division I. Spring, of course, the most critical selling season for Home Depot as shoppers plan construction projects in the warmer weather. In fact, I am making a stop at Home Depot on the way home. Get some more 2x4s.
Not Kohl's.
Well, maybe
Good
Kohl's,
distinction. Good
after
distinction.
I ripped my pants at Home Depot. For 4 decades, the River Bend Festival delighted music fans in Tennessee with headlining acts like Lionel Richie and ZZ Top. This year, the show won't go on. After years of growth, music festivals are in retreat. At least 10 shows in the U.S. have been canceled. The founder of festival organizer Brouhaha Productions says everything is more expensive. Going to a multi-day festival can top $1,000. That's your company news.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Tuesday, everybody. I'm Alex Steele here with Jen Ryan. Paul Sweeney is off for the week. You're listening to Bloomberg Intelligence, where we get all our amazing analysts that cover 2,000 companies and 130 industries around the world to give you their insight. We also want to give you insight with world and national news. Here's Michael Barr.
Thank you very much, Alex, Jen, and John. The special counsel who investigated President Biden's classified documents case is getting grilled on Capitol Hill. Robert Hur is testifying right now before the House Judiciary Committee. Hur has been accused by Democrats of inserting an unnecessary opinion in his report about the president's memory and mental acuity. Hur categorizing the president as a sympathetic, well-meaning elder